learning opportunities that have been put together for all the students and the faculty. Welcome to all the esteemed guests. Thank you so much.
Thank you, ma'am. Thank you so much for the inaugural address. I now request Dr. Pankaj Trivedi, sir, Head of Department of Finance and Law at Somaiya Institute of Management, to speak on the journey of Investrix.
Chief guest of the day, Mr. Ashish Chauhan, our Director, Madam Dr. Monica Khanna, my faculty colleague, invited guest, alumni, and student friends. Good morning and warm welcome to all of you for our annual program on financial market called Investrix. Investrix is an annual program and much awaited program every year because here there is a corporate panel discussion on some contemporary issue. As Madam said, this program is very old, more than 3 decades old, and always the students and the faculties are waiting for it. Every year, we invite market leaders and investment decision makers to hear from them their views and experience on some contemporary theme. This year, the theme of the program is investment in new era. The program is all the more important this year because I'm sure all of you will agree with me that year 2020 is unforgettable year, not only in India, but in the entire world. It has upset everything because of the COVID pandemic. It has upset financial market, it has upset economy. Not only that, it has upset even the human life. Everywhere you find there is uncertainty and fear. The financial market across the globe, right from March, all of you must be observing, are falling, rising, again rising, falling, rising, falling. These keep on going. Even yesterday also you must have seen there was a lot of ups and downs in the BSE. So at such time and in such environment, naturally question arises that what will be the future of this market? How to take investment decision in this climate? And various other questions. So to get the answer and to get the insight into these issues, we have invited a galaxy of speakers. We have invited the people who are working in this field on day-to-day basis, who are the decision maker, and they are going to share their experience and knowledge with us. So I welcome all the speakers for this wonderful event, and I'm sure that at the end of the event, there will be so many takeaways for all of us, and there will be so much learning for the students. So once again, welcome you all, and I declare that this program is open. Thank you.
Thank you, sir, for taking us through the memorable moments of Investrix. Investrix 2020 has been made possible because of a committed team. It's none other than Team FinStreet, the official finance committee of Somaiya Institute of Management. FinStreet has been organizing innumerable informative activities and programs to provide rich and varied experiences to students of our institute. So let's have a glimpse of the journey and events at FinStreet. Investrix 2020 comprises multiple sessions throughout the day. Let's have a look at the events lined up. Our first session will be the inaugural session addressed by Mr. Ashishkumar Chauhan, MD and CEO of Bombay Stock Exchange. The next session will be a panel discussion. Following the panel discussion, we will have a guest speaker session addressed by Mr. Saurabh Mukherjea, founder and chief investment officer at Marcellus Investment Managers. The final segment will be the Bizwiz Talks, where the moderator will have virtual conversations with the guests. Today, we have amongst us a well-known name from the industry. I am honored and privileged to introduce our distinguished chief guest, Mr. Ashishkumar Chauhan. Sir has been the pioneer of Nifty Index and screen-based trading in the country. An alumnus of IIT and IIM, he is currently the MD and CEO of Bombay Stock Exchange. Mr. Ashishkumar is one of the most influential persons in the world of modern finance. His core philosophy has indeed made his career path a dream journey. His sharp skills and acute foresight have made him a trailblazer in the world of modern finance, and he is acknowledged as the father of modern financial derivatives. An NSE co-founder, Mr. Ashishkumar, was president and chief investment officer at Reliance Group. Another feather in his cap has been the activation of Indian International Exchange, which was inaugurated by our Honorable Prime Minister Shri Narendra Modi. He has co-authored a book on the history of BSE titled The Temple of Wealth Creation. Mr. Ashishkumar is a distinguished visiting faculty at reputed international institutes and has garnered several international and national awards throughout his career.
We will have to hold for a couple of minutes. He'll be just joining soon, in 2 minutes. Thank you. Swapnil, there are a lot of people who've joined in a little late. So can we have the FinStreet video played again till Sir joins in? Pankaj sir, till sir's here, could you please talk a little, give us a brief how about a committee, about finance and all of that?
Certainly, I will talk. I was about to tell you that. Yeah. So, as I said, Investrix is an activity. Let me give you idea about Investrix till the chief guest will join. Any moment he is likely to join, of course, because he is very particular about timing and all that. So I wanted to just inform the audience that Investrix is totally student-driven activity. Everything is done by students. We faculty just guide them. Otherwise, identifying the speaker, contacting the speaker, talking to the speaker, arranging everything, flawlessly everything students are doing. And I'm really proud of all FinStreet students and all students of peer committee. For this program, for example, for this program, they have worked hard. They have taken care of even smallest of the small thing. What should be the backdrop, at what time we should start, what we should do, what we should not. So this is how, apart from whatever they learn in their classroom, apart from whatever they study in the subject, they also learn by experience. And every year, FinStreet is getting higher and higher heights. For example, last year, we have made tie-up with CMT, Certified Market Technicians Organization of USA, and we were able to get the leaders of CMT to the campus. Last year was little different. We could do this program physically. So we could invite them physically to the campus, and there was a wonderful session on technical analysis. So like this, year after year, with your support and with the support of our director, madam, as Krisha has said in her opening remark, that the true leader, she always supports us and she always gives us full freedom. So we are able to do all this thing. I think chief guest has already joined. It seems that he has already joined. Am I right? So we will hand over the floor to the chief guest. Krisha, am I right?
Yes, sir.
Yeah.
Welcome, Mr. Ashishkumar, sir. We are honored and privileged to have you as our chief guest. I now request our distinguished chief guest,
Thank you.
Mr. Ashishkumar, sir, to address the gathering.
Thank you. It's a pleasure and honor to be in front of you. I think today we are basically talking about the stock markets and how they are going to evolve. For that, we need to also understand how the stock markets are going to evolve or have evolved in the past. It's where basically we need to see how the stock markets across the world moved, how did they come about, and what could be potentially the future. Stock markets are very important for us to get excited about. We know a huge amount of wealth is created by some people. We get excited by them. We want to emulate them. But that is not the fate of all the participants. It's very similar to movies, somewhere one person like Amitabh Bachchan comes from Allahabad and makes it big, or Dharmendra comes from Punjab and makes it big. Every child wants to become a movie star. And that's where basically the life goes for a different turn. And that is true with the stock markets also. Stock markets have largely two parts. One which excites us every day in terms of motivates us for trading is basically something which I call transaction processing. And the second part, which is what actually is the essence of stock market, is the capital formation. That is the raising of funds and ensuring that the capital formation in the country happens. Usually, most of the talk relates to basically the first part, that is the trading, the transaction processing. It is three parts. The first part is transaction itself, that is called trade. Second is deciding on obligations, which is called clearing. And third is basically the obligations that are settled in by way of giving cash or by way of giving securities. So that's called settlement. So trading, clearing, settlement is what finally works out in overall transaction processing. And if you look back, the companies on whose shares we trade, and the stocks which we trade. In stocks, there is a promise of a profit which we share. What is a stock, right? It's basically a collective investments by everyone who are called the owners or the investors, and they give the run the company and make money for the owners, and so somewhere on the line, the Bitcoin has no promise of profit. It's just that you have to find the next fool. Until the time you keep on finding the next at a higher price, you are okay, or even at lower price, you are okay. But other than that, the similarity, because in the stocks where you invest, in fact, if you look back, the original way of doing business was individuals. Every individual used to do work and produce profits, and that's how we got artisans like carpenters and blacksmiths. For time immemorial, in the history of the world, wonders, and over thousands of years, so that endeavors continued. And then later on, the partnerships came, where to the people who you partnered with, and you trusted them, and that's how the work got shared, and that allowed you to scale up. And if you read some of the other interesting ways of getting together to scale up each other's work, there are things called guilds, GUILD. If you read about guilds, you will figure out they were essence, and they would give certifications, they would take care of the interest of their members and things like that. But in Sangam era, some of you who are Tamils might kind of be aware, around 2000 years back also, in India, in Tamil land, there is history of a lot of such guilds doing trades across the entire eastern side. That includes Java, Sumatra, China, Indonesia, and Malaysia, Thailand, and so on and so forth. So effectively, those ways of scaling up were getting developed. And so from the individual to partnership to guilds, which were very loose situations, and then came the company, which allowed more people to participate. And that's where around 12th century, 13th century in Europe, this developed. The same time they started coming to India, trade, basically the India coming, and there was huge growth of commercial activities and physical activities across the world by way of trade. And that's where the companies became a primary mode of doing large activities. And that allowed people to scale up and things like that. And of course, get more money, but also they employed more people. So today the corporates employed largest number of people. And that's why they are so much more useful to the society and to the economies they operate in. And that's what basically the two parts of the stock markets. One is the corporates, which are larger limited liability partnerships, I would put it. Of course, you have heard of LLP also in India. But these are like very large scale partnerships, which are the companies. And then you have the trading part of it, that is the transaction processing part of it, that is the trade, clearing, and settlement. So the stock exchanges work both these functions, and they go hand in hand. So that comes to Indonesia, and then when it comes back with huge profits, and the profits will be shared among shareholders, the owners who were having particular shares in their in that voyage. And that's how most of the transactions or commercial activities used to take place to the sea shore. So on the seashore, they used to keep the registers and of the names of the people who were owning share of profit in that particular voyage. And that's how when a ship would come, will kind of figure who is going to get so much. And those days, coming to India and going back would give you profits of literally 1,000 times or 2,000 times, almost like today's internet companies. And so people were sort of getting together and putting a lot of money into such companies, and more people started putting money. That's how the registers became larger. And that's how, if you heard of registrar of company, it's basically register of the shareholders. And when the voyage went to India, came back, it would take 2 years, half years. By the time, if you have some share in that profit, you want to sell it because you need money, the secondary market started. And that's how on the seashore, people would get together wanting to buy and sell those shares of the voyages. And instead, a new breed of people developed who be the intermediaries. They would help you buy and sell such shares, or sell you when you want it, or buy from you when you want the money. And people started becoming richer themselves. And that's where basically they started sitting in coffee houses, because Europe is being, a very cold place. And so 6 months of year, they can't move around on the streets. And that's where they're sitting in coffee houses. When they started buying their own places and called themselves guild. And they started calling them stock exchange. Went to the local ruler, gave them gifts, and took the local monopoly, which every guild had to do it. Now those gifts are called bribes in modern democracies. Give it to princes or they were actually the gifts, and they would in turn give you the license. And that's how the first stock exchange was set up in Amsterdam, called European Stock Exchange, which later on became European Stock Exchange. Now, if you go to Amsterdam, visit that. But effectively, 1607, that first exchange was set up. In the same framework, came up around 1820s, 1800. There are instances of the bonds getting traded off banks and all, but even 1840s markets, but there was a cotton boom based American war, and the cotton from America stopped going to UK, Manchester mills, and that's where the Indian cotton prices went up, and many people became really, really rich in a very short time. The cotton prices went up like 10, 15 times in a very short time. And those people were also involved in the stock trading. Those people were also involved in running banks. And some of those people were also setting up industries. And they, when the bust happened, because the American Civil War ended, many people went bankrupt. But whoever survived started borrowing money or taking the money to set up industrial activity, like getting the textile mills related stuff. And set up textile mills in Mumbai, in Nagpur, in Ahmedabad, in Kanpur, and that's how India's first industrial boom happened around 1866. And in 1875, around 370 people got together under a banyan tree near BAC. There's a place called Horniman Circle. They got together, and there used to be, basically, they were also cotton traders, many of them. Some of them were bullion traders. And they got together, set up an association of person called Native Share and Stockbroker Association. And native as opposed to Britishers. Because in many places in those days, in Mumbai, Delhi, everywhere, the Indians were not allowed because Britishers were ruling, and they didn't want Indians to be there except as servants in those cozy clubs. This was a club of Indians, for the Indians, by the Indians, to collect money from other people, put them into industrial activities, and then sort of, if that make profit, then share that profit. So effectively, where in 1875, all these things started in Horniman Circle. Try visiting that. And then they would make a lot of noise. usually they used to trade by handshake, and they would put a napkin on top of that. And so they will trade with moving of fingers underneath the napkin, so non-transparent way. Then it became too large and started making noise, and somebody else will complain. So they will be thrown out by police, like what to young people, and so they would run away to another corner 200 meters away, which is now known as Dalal Street. And then they became rich. They bought their own building, and that is how the Bombay Stock Exchange or Native Share and Stockbroker Association actually started having its own building, and it was a local monopoly. In 1850s, again, the UK government announced the Companies Act, which became automatically applicable to India because of the India being ruled by British Raj. In 1857, after the first revolt, the British Raj started directly ruling India, and so effectively it all kind of fell in place, and that's how the Industrial Revolution was literally funded by you and me, people who don't know each other. Money, and that's the beauty of stock market. Banks, each country, each ruler likes banks, especially modern banks, is because they can direct credit. Can be told to invest money into somebody or give loan to somebody. But if you tell Ashish Chauhan that we are coming out with an IPO of this company or a bond of this company, get this subscribed, I have no clue. I am not myself rich. I'm only an employee, right? It's the money from other people, completely unknown people. If they feel like they will invest, if they don't feel like they will not invest, right? So that's why the governments like banks, they can direct things, right? And many of them have aspirations that once we direct, what we say will happen. And that's how post-independence India gave very little importance to stock markets, huge importance to banks. And in the process, we also had 5-year plans, which probably you might be taught, at least we were taught how they importance, very little importance to the stock markets. In fact, in older days, when I grew up, the stock market was a gambling den. It is called Satta Bazaar, right? There was a movie of Saigal when I was not even born in 1950s, where it was basically shown that it's almost equivalent to gambling. But slowly people realized what great function the stock markets perform. Why I'm telling you this story is that stock market's main function is basically capital formation in the economy. That instant trading you see every day, $50 billion, $100 billion every second, every microsecond, BSE is the fastest exchange in the world, is basically to promote the capital formation, creation of jobs, and so on and so forth, right? But why it happens is a person sitting in Jammu or a person sitting in Japan, in Osaka, which is near Coimbatore, that person never visited. Our money is going to go to the right place. If that company makes profit, she will get the share of her profit. She has a claim of share of that profit. And it is so beautiful, but the system works on trust. The stock exchange, despite all the, all the perceptions people create about stock exchange, we don't have too many powers. We can't put people in jail. Well, our role is to get the information from the company, put it on our website. Other people, that is investors, non-investors, media, they have to look at it and talk about it. And if they feel like they will invest in that company, right? Or sell their shares. It's basically completely working out of trust. So what we manufacture as a system is trust. But that trust is so unbelievable. And of course, all of us, but the larger, it is few, the value of the stocks that are listed on BSEs, you know how much? $2.3 trillion. it's purely out of trust. And if you take the bonds, which is also on trust, because you are buying and selling, actually you are putting money directly into the company. And so if you take the commercial paper and bonds and other stuff, the total value is now $3 trillion. India's total wealth is around $9 trillion. So effectively, 1/3 of India's wealth is represented by that building, that hall in which we all used to trade. But that $3 trillion is 1/3 of India's wealth working out of purely trust of unknown people on unknown people. And that's why all these rules, regulations, everything is so much more important to follow, even if you don't want to follow. Because if you make a mistake, if you do anything which is not trustworthy, you are going to affect, as the corporate employee or a corporate owner, other people also. And that is so much important. No developing country in the world at our stage of economy, India is lucky to have this market, which allows to basically you can actually tell other people to give you even 50 lakh rupees, 1 crore rupees. And if you want to even take 1 lakh crore, you can still do it through BSE. So effectively, you are able to basically raise any amount, literally very small to very large. And that is what the beauty of this market is. And what we and to lose, very difficult to. People have continued this. There have been problems, there have been issues of trust, and slowly it has rebuilt, because the companies which have raised monies, or like there are many companies which have seen 3 centuries, like BSE has, and some of them are like Wadia Group, Wadia Group, the Britannia and Go Air, and the shipbuilders, and they used to also. Similarly, many other companies or group and they came down, but effectively what the stock market represents is the wealth of the nation, and it also moves with time. So the company, if some of you want to do research on that, primarily to create Nariman Point. You recall Nariman Point? Have you been to Nariman Point? That Nariman Point is basically, right? Even this is all reclaimed land, and there was a company that it came up, it went up, and but effectively the of the country is what is represented by stock market. Of course, we need to companies which basically so we provide secondary market. Then we also have derivatives, which are basically options, and we also provide many other platforms, bond platforms, mutual fund platforms, and so on and so forth. But what is provide you or provide society with a trusted mechanism to raise money for equities, which is called risk money, because it makes losses and it'll go down to zero. And that's basically, but it's money and it's a profit. Additional projects, but effectively the framework which has been created in India, not many countries are successful in creating that trust framework, and India has done wonderfully well. With that, I think I will stop here, but if you have any questions, we can probably take up till the time the organizers want.
Thank you so much, sir, for illuminating this and the amazing insights on how you spoke about the evolution of stock markets, and right from scratch, right from the inception of Dalal Street. It was really interesting to know about it right from scratch and exactly from you. So this is going to really help us with all our footsteps in the corporate world as well. So for us budding managers also, all these insights are very useful. So we have a few questions. May I go ahead?
Yes, please.
So the first question is from an alum of Somaiya Institute of Management, Mr. Hitesh, from the 17-18 batch. With the new margin rules being a huge dampener for intraday trading, is there any scope of leniency in certain products like futures in the coming months?
Or the system faces in the immediate past or even slightly distant past. So why this regulations come is because some lacuna are found, some misuse is found, and that's where people who are used to doing it under a particular circumstances start opposing it or start feeling worried about that, because it's human nature to do things which are basically continuing. You don't want any uncertainty, you don't want any change. That is the human nature, right? But the other part of the world is that the entropy keeps on increasing. That is, the chaos keeps on increasing. So you have to continue to reduce that energy, newer and newer regulations. So this new regulation has come after many decades of misuse of people's money. Like there is a new default called Carvi securities. So whoever has asked the question and whoever has not listening to this should read up about Carvi securities. Right, the default was almost very large, and then slowly SEBI tried to unravel that and give as much money to people. And NSE is also trying even now to get more of things for regulation. Second thing is called Anugraha. If you have heard of Anugraha stockbroking default, this happened in last 1 year itself. So they are not new. Just search in news.google.com Anugraha stockbroking, and you will find a lot of articles on them. Similarly, if you if you write Carvi stockbroking default, you will find, and there are around 20 defaults that have happened in this year itself, the largest since I became part of the stock market fraternity in 1992, right? So literally in 30 years, this is the largest number of defaults. One of the issues which we try to manage using regulations is basically the risk on the system. We try to minimize. Then risk on the brokers. Even if a child wants to run fast, the parents stop them, right? Because they might fall. So you don't want them to take too many risks. And then you don't want also the customer money at risk, because many times one customer's money is used by the brokers for settling off or settlements of other customers. And so many of the newer regulations, including pledge repledge and many other things that have come are because of that. One thing I've observed since I set up in 1994, when I started working on it from 93 onwards, 92 and 93 onwards. And I ran it for first 7-8 years. I also created Nifty index. I created the derivatives. I created the screen-based trading for India, and so on and so on, including the tech Bandra Kurla. But effectively, since last 27, 28 years, whenever you make your rules, then more scandals come up, and then they create more problems, taking away trust of people. So as I started, my overall speech is about what we manufacture as system, the RBI, SEBI, Government of India, all the investors across the world, that India's stock market is very good, right? And that is basically the attempt here that in future also many such regulations will come, and you cannot be a what I call an investor who is worried about margins. Then you have to be basically a trader. An investor, 5-6 years, 10 years duration, or even 100-year duration. A trader is trading for morning to evening. But after looking at watching television, and you think that buying in the morning and selling in the afternoon is called investment. It is not, right? So whoever is doing is probably a trader. And trader also will find many ways to sort of use the margins efficiently, even with new rules. So, but effectively, whenever the rules become slightly tighter, more and more people come in because they find more trust, right? So I don't think there will be any leniency, if at all, plus a little bit might be given in terms of extension of time. But overall, SEBI is very clear this time that leniency is what is leading to all these defaults.
Okay, thank you, sir. The next question is by Mr. Dinesh, again an alumni. Is it real market in India as Sensex and Nifty are all-time high in this pandemic, whereas there is a lot of loss of jobs on ground?
It's again interesting. Yeah, it's the same question being asked, and all I want to also understand why why Dalal Street is different from real street, right?
Mm-hmm.
And there are reasons. What Dalal Street does is basically it takes next 40, 50, 100 years of the future growth. All the profit will accumulate to the companies which are currently listed, do the net present value of that, and basically come at some valuation. That is broadly one way to do it. The second way is by demand and supply, right? If demand goes up, prices go up, supply comes up, prices go down, right? So these are two ways you price any activity, right? And so when the COVID period, it will never come to us, but Iran, and everyone got really worried that this is the first time, at least in the last 100 years, where people die without knowing what hit them, right? And it happened in 1917, 1918 in Spanish flu. After that, if you are having a war, then you die, right? Or there were also minor problems in the last 20 years like Ebola and other stuff, but nothing as big as this. And so people thought that, and especially in February and March, we had so many experts of Indian origin coming from America, where America, nobody listens to them because they are brown or otherwise also. They come to Indian television and start giving you all sorts of gyan, right? Which I think our television gobbles up and makes us listen. So those guys had predicted, if you recall, take out those sort of interviews, that India from April to June, India was supposed to have 10 to 20 crore of infections and few crore deaths. If that had to happen, then all the future profits of those companies listed would have gone down substantially forever because of the panic, anarchy, chaos and all. And that's why the market fell down by 40%. From 42,000, it came down to 26,000, right? And then as the time passed, people were more worried because the disease had come to India. But people also realized that it's not that we are like 20 crore affected. It's not we have few crores dead. Slowly we realized that somehow India is done well because we went into lockdown, which was a kind of a brave move on part of Prime Minister. And then, of course, we also are worried about food riots. And once you put people in lockdown, they can't eat, they come out on road, start throwing things. And so they also provided food for free, which they are still going to do. I mean, in December also they're providing free. 80 crore people are being provided free food. So what happened is, slowly people realize that it's not as deadly as it is made out to be. And even if it is deadly, we have not done badly. And that's where basically, if you look at now, almost 7-8 months, the world was supposed to have literally crores of death, 10s and 20s and all. And world has not done badly, but India has done exceedingly well compared to the world. Today, on a per million infections, we are in 100 or below. Yes, out of 160, We are not even in top 100, right? We are like 105 per million infections. Although we are number 2, but then we are 20% of the world population, right? So we have to be number 2. China stopped counting after 80,000. After 80,000, they just said that no more addition. Everyone accepts because it is China. Whereas in India, I mean, even if you have 80, you make it 8 crore in some of the news channels. And that's how the MCs work, right? But whatever the case, people realize that slowly the market started growing up. The second part is that from 97, there was American president. He no longer US dollars will be backed by the gold. After that, the money of US and later on money of every country became basically like Bitcoin. There is nothing behind. But only government, that's why it's called fiat money. Neil Ferguson's history of money, and there are many. Basically, it's fiat money with no, basically, literally governments print or the Federal Reserves or Reserve Bank of India and print literally infinite. So anytime since last 50 years, there has been any crisis, man-made or otherwise, governments have put more money to keep the people confident that nothing is going to happen, nothing bad is going to happen. And that actually increases the asset amount of money. That money overflows into the asset prices. And which is the asset group, which is the most liquid? That is the stock market, right? Because stock markets don't have stamp duty as high as the land or so trade. In every day we would get 50-60 crore orders, right, in 6 hours. So that is the kind of liquidity you get in no other asset class. That's why in first April to say June, July, the governments of the world put in $15 trillion as additional fiscal measures to overcome the panic of COVID. And that's where that as sort of that money into the stock market by way of bank, other things. That's again to also one of the reasons. The larger reason is still the same, that everyone is now comfortable that the losses, however difficult to handle, they are still manageable compared to what the initials were, and that's why they have come up. While the current situation is interesting, the larger companies are actually making good profits. The listed world, if you look back in last quarter, as well as you will see in December quarter, January, you start getting results, you will see the listed world is actually making good profits. It is the rest of the country that is not doing so well. And some of the trends which were now sort of fructified in 6 months. The companies which would have become dead in 25 years have suddenly become dead. And companies which were nowhere are doing exceedingly well. Like, for example, I'll give you one of my friends in Pune. He was just calling in the middle of this. I had to stop. He told me last week when I called up that he in big data, and he had 200 people before the COVID started. Now he has 700 people. There is another lady who knows me. She had come to meet me in my office on Monday last, that is last week. Told me he sells one Pune-based sweet manufacturer. You might know Bhakarwadi and sweet and all. She is there, and because she was connected to Amazon and Flipkart and all, she said my business never went down, but cashew nuts and other things in a package format. She was showing me the pictures of her factory and all, and she has now employed 3 times more people than she had in February. I also had who is into steel, and he said that steel secondary and tertiary players are in deep trouble because the primary manufacturers of steel in India jacked price so much that the secondary and tertiary guys are not even able to have good products because manufactured in India. That is going to affect the India's exports in the automobiles, where is the larger user. Goods still at sort of comparative prices, able to export. So there are, in fact, yesterday or day before yesterday, Mr. Nitin Gadkari, so I mean, road laying is now becoming difficult in terms of being very costly. And so those are the issues which every country, not only India, but we run our financial systems, our other stuff, but also entire world systems. All the banks of the world, literally any bank with probably 5,000 people or more, are having their back office here. Despite lockdown, we ran them. So we have done some wonderful work as Indians. We should be justifiably proud. And the last part is, if because China is doing badly internationally in terms of the perception, people want to move away from them. If our government, our diplomacy, all of us put together, if we are able to get some concessions for our textiles, today India exports $15 billion of textiles, garments and all. Bangladesh, which is 1/7 of our population or 1/6 of our population, exports $33 billion, $35 billion. And China exports $160 billion, right? And so if you can go from 15 to 150 over the next 3, 4, 5 years, the number of jobs over end that can get created is huge. The IT jobs, today we are doing a very large number, $250 billion exports. Now that world has tremendous confidence in India, if you can make up to $1 trillion, that will be another huge stuff, right? And then pharmaceuticals, we are doing so well that we also supplied a lot of pharmaceuticals to the world during COVID panic, sometimes even free. And this is when such epoch-changing things happen, there are winners. India is on the winning side currently because of the way it has handled itself. But some of the businesses have not doing things. The ones who have been left behind also will do well going forward.
Krisha, you're on mute.
Am I audible? Yeah. Thank you, sir. We're sure that each one of us will benefit from the knowledge that you've shared today. And indeed, your journey has been an inspiring one. And it's an honor to have you, sir, today as a distinguished chief guest. Thank you.
And have a great conference. All the best.
Yeah, and I now just request Dr. Pankaj Trivedi, sir, to propose the vote of thanks.
Yeah. Thank you, Mr. Ashishkumar Chauhan. Thank you very much for two reasons. I would like to thank you. I recollect in the last Diwali, not this Diwali, last year Diwali, Brokers Forum has given a party, and there I met you. And you told me that one day I will definitely come and address to your students. So, though not personally, but virtually, you have made it. You have made your promise. So, thank you very much for that reason. And number two is, in a very nice way, you have covered the subject, which probably students are not aware of. Our students are aware of the trading, the settlement, etc., other things that we have just touched upon. But the history of stock exchange, what is the significance of stock exchange? What is the significance of capital market? That you have covered very nicely, and I would like to thank for that. The new concept that you have put up in front of the student, that is guild. So I'm sure the student will explore more about the guild, they will read more about the guild, and they will learn more about it. Second most important thing that you have covered, which probably very few people are covering, and that is capital formation. It is not only trading, it is not only making good money and quick money. It is something which is important for the economic growth, development, and inclusive growth. And that is possible only by capital formation, where stock market plays very important role. And the third aspect which I want to cover, and what you have said, is the trust. You are the people who manufacture trust. So this is something which is very great thing that the students of finance should understand. Not only that, you have also given some of the good recommendations how India can perform better in the global trade and in international trade. So for covering in a short time all these aspects, and that too in a very simple and lucid way, definitely deserve great congratulations to you, sir. And thank you very much, sir. Thank you very much for that. I take this opportunity to thank our director, madam, Dr. Monica Khanna. As I said, before you came, I was just talking that she has always given us all freedom to go ahead with these kind of programs and anything that is beneficial to the students. So thank you, madam. I would also like to thank all my faculty colleagues for their continuous support, especially Professor Hitesh Punjabi, because he has taken a lot of effort to organize this event, to contact the speakers, and he also done very good work. So thank you very much. My Fin Street students, as usual, they are doing wonderful things and a lot of effort they have put up. Same way, personal thank to Arvind and the entire PR committee. They have played very important role in popularizing and making this event more famous. And finally, alumni for their continuous support, and dear students. So I thank all from bottom of my heart for making the inauguration function a grand success. Thank you very much.
Thank you, sir. We could just use a 5-minute break, and then we can move on to our next segment, the panel discussion.
All right.
Warm welcome to everyone. We now move on to our next segment of the event, the corporate panel discussion with the industry stalwarts. But before that, let me give you a brief overview of Investrix. Investrix has been a legacy of KJ Somaiya Institute of Management for over 3 decades to bring eminent personalities from the financial sector to a common platform where they discuss and share their ideas. The ideas shared at Investrix provide the much required impetus to the budding managers for insights into the finance industry and bridge the gap between theory and practice. We present to you a short video to take you through the journey of Investrix.
Krisha, unmute yourself.
I would now like to give a brief introduction of an eminent panel of experts. Our first panelist for the day, Mr. Madhusudan Kela, a man with humble beginnings. He is an esteemed alumnus of our very own institute, KJ Somaiya Institute of Management. He's a founder of MK Ventures and former chief investment strategist at Reliance Capital, under whose tenure the assets under management at Reliance Mutual Fund grew to a staggering rupees 1 lakh crore from just rupees 200 crore in less than a decade. He's one of the most respected and seasoned investors in the Indian capital markets with a rich experience of over 27 years. Mr. Madhusudan Kela devotes a significant portion of his time to spiritual and philanthropic pursuits.
Our next panelist for the day is Mr. Neelesh Surana, the Chief Investment Officer at MIRAE Asset Investment Managers, India Private Limited. He is one of the most decorated fund managers in the Indian mutual fund industry. He has had a distinguished career and an extensive experience of over 2 decades in equity research and portfolio management. Recipient of several awards throughout his journey, he started his career by being on the sell side, and for almost 17 years, he has been on the buy side of the business. He played an instrumental role during the 2008 crisis and helped MIRAE's assets AUM grow drastically almost 200 times after it dipped tremendously during the crisis. He currently manages the MIRAE's Asset Emerging Blue Chip Fund, which has given phenomenal returns and has received several awards. Coming to our next panelist, Mr. Shankar Sharma, also known as the alchemist of Dalal Street. He is a dynamic investor, a successful entrepreneur, and one of the best advisors. He is the vice chairman and joint managing director of First Global for over 30 years. He is known for his judgments, wit, and is pretty vocal about pointing out fault lines in the market sentiments. Some of his accurate predictions include the 2008 crash, the oil crash to $30 from $150 in 2008, and many more. Mr. Sharma has been widely quoted in the Wall Street Journal, CNBC, Financial Times, and has also featured on shows like The Mind of the Market on NDTV Profit. He always believes in the philosophy of market entry and exit at the right time.
Our next panelist, Mr. Sankaran Naren, an alumnus of IIT Madras and IIM Kolkata. He served across various roles in the financial services industry and investment management. Mr. Sankaran Naren is presently the Chief Investment Officer and Executive Director of ICICI Prudential Asset Management in Mumbai and is among the most respected names in the Indian fund industry. He became Chief Operating Officer of HDFC Securities before joining ICICI Prudential as a fund manager in 2004 at when awareness of mutual funds in India was very low. In 2016, he became Executive Director of ICICI Prudential. Mr. Sankaran Naren steadfastly sticks to his convictions. He cites the investing tenets of renowned investor James Montier and believes that if an investor wants to make money, he or she must be a contrarian and believe in value. Next is Mr. Ajay Sharma, our moderator for the day. He's among the top editorial team members of ET Now, having worked with the Times Group for over 12 years. Market intelligence combined with macro analysis is the bedrock of the work Mr. Ajay is engaged with at ET Now. Regularly interacting with top global and domestic fund managers on their portfolio allocation approach and also quizzing top industrialists on their business strategies is a critical part of the work to spot themes in investing environment. Studying businesses and entrepreneurial journeys of founders is Mr. Ajay's personal hobby, apart from traveling and being a foodie. Mr. Ajay is in charge of striking key partnerships for on-ground events and conferences for ET Now, and also contributes to the group's flagship properties like India Economic Conclave, NSE Nivesh India, NSE Prosperous India, and ET Market Summit. A very warm welcome to all our distinguished panelists and our moderator for the day. So moving on, our theme for today's event is investments in a new era. The first half of 2020 has seen an unprecedented decline in the economy. With a mostly shuttered economy and price fluctuations, the pandemic we are currently living in will make even the most skilled investors dizzy. In the post-COVID-19 landscape, new consumer trends will emerge. Investments in the new era will add a different dimension to investing. Being nimble and adapting to the new emerging trends will help us make sound investment decisions. We now present to you a short video on the theme of Investrix 2020. Considering the current economic scenario, we all have a lot of doubts about what's in store for us next. So without further delay, let's dive straight in and hear from our experts. Also the audience, during the session, you all can put your questions to any of the co-hosts, if any in the chat box, Danish or Prakhar, the name of the display name would be that. And I also request the moderator, Mr. Ajay, to take the session forward.
Thank you, Krisha. I hope I'm audible clearly. First of all, Dr. Trivedi, Professor Punjabi, KJ Somaiya Institute and Vidya Vihar Somaiya Society. I would like to thank all of you for organizing this amazing event every year. This is my second or third year I'm associating, and it's great to be here. All the more because of the panelists this time, some very key contributors for our own channel ET Now, and some of the people I've learned a lot over the years. Madhu, Sankar, Naren, Neelesh, and of course Shankar also joining us now. So, Madhu, I would like to start from you. It'll be a great session. We have enough time. Also, because it is for you to participate. It's like homecoming for you. I'm told that decades back, when you were starting off and you were laying the understanding of finance and markets, the foundation for yourself, you were part of KJ Somaiya, and you were instrumental in setting up this event or kicking off this event, which over the years, of course, has gathered a moss and has become one of the most prestigious events. So just let's take a clock back and let's start by how is it feeling coming back and participating as a panelist now?
Thank you, Ajay, and thank you, the organizing committee, Dr. Trivedi, and everyone at the institute. I must say I've done many events in my life. I have appeared and done many panel discussions and participated. This seems to be the most exciting event for me till now, because this is really homecoming and you getting, in a way recognized in your own home ground. This is a really matter of proud. I must say that, and I also feel so nostalgic coming here, because this was started like a casual chat between all of us in 1990 when I was in the institute. In those days, there was no internet, there was no web. So what we thought, this Investrix is basically investment tricks. That is how the name Investrix came. So Ajay got back in those days. We had to really fight with the director to hold this fair, because the director told us that this will incur huge losses, and who will pay for these losses? And we, all of us, the 89-91 batch, I convinced all my friends and colleagues at that time that we will make profits. So we took the onus of this. We made sure the institute did this fair. Those days, all of us had sleepless nights, went through the posters ourselves, stick those posters in the local trains, and made sure that we had popularity among people to know about this fair. On the other hand, we got in touch with who and who of the financial world. Those days it was Mr. Fairwani, Naina Lal Kidwai, Vinod Ambani, and so on and so forth. And it was real fun. I feel so nostalgic, I can't tell you that, and I'm so proud and happy to see that this journey is continuing even after 30 years. Dr. Trivedi, I'll just request you, if you can find a video of 89 of our discussion and how actually this started, it will be great to see that video. I don't have it, but it will be great to see that video. So very happy, Ajay, and thank you so much for having me.
Great. So Madhu, I'm sure all the students and all of us will learn a lot in the next 1.5 hours. Let's get some initial words from Naren also. Naren, can you hear me?
Yeah.
Naren, you're somebody who likes to watch cycles very closely. So, we are the main theme of this discussion, investments in a new era. How do you see this new era? Do you see a new cycle beginning?
So this is a central bank era where, if you look at it, we all think we are fund managers, but we are responsible for the markets. But progressively after 2008, the central bankers have taken the role of fund managers, and they've taken the role of the fund managers, and they've taken the role of ensuring the stock markets never fall. So I think the new era actually started in 2008, and that era is continuing. So in 2011, when the stock market fell, the central bankers realized we can't let the stock market fall. and they did not let it fall. And in 2018, when the stock market fell in the fourth quarter of 2018 in America, immediately the central bankers got in and immediately ensured that the stock market can't fall by pumping in record money. So if you look at 2020, I think the central bankers showed that they are bigger than the stock markets by pumping in record amount of money in March 2020. So imagine we held this event on March 17, 2020, and someone told you that the number of cases in COVID will be so many in the world, and we would all be operating out of homes for bulk of 2020. I think no one would have guessed an index level of 13,700. But the central bankers pumped in so much of money this year that they ensured that the Nifty went to 13,700 and Nasdaq, S&P and Dow went to new record highs, and every global stock market went to record highs. So the new era is that actually the central bankers are the people controlling the stock markets, and eventually it is the central bankers who will cause the stock markets to fall dramatically at some point of time. And many people will blame fund managers for it, but actually they will have to blame the central bankers for it, because the central bankers will be the people who will decide when the stock markets will fall, not the fund managers. We are all small people in this game. Because we are not capable of pumping $24,000 billion of money. Next year, it seems they are going to pump $4,000 billion of money. And we are capable of pumping $1 or $2 or $3 billion. In fact, this year we have seen outflows. Despite the outflows, the markets have gone up. So I think we have to remember we are in a new era. Clearly, we are in a new era. In that new era, the reality is that it is central bankers who control everything, and we are all small parts of the game. So I would like investors to know in the world that it is the central bankers who are responsible for the bull market, and eventually when there is a bear market also, it is the central bankers who are responsible for the bear market. Because if shares are trading at 50 and 60 and 70 PE today, they can go to 120 PE also, but that PE will be decided by the central bankers. So clearly we are in a new era. That part also, because no one would have imagined that all the top corporates in India will raise money at 3% in CPs for 3 months. All the public sector units today raise money between 4.5%, 5% for 3 years. Again, it is because of central bankers in India. Because I don't think we would have ever imagined that for 3 months you will be able to raise money for 3% Indian corporates. So we are at the lowest level of interest rates ever seen in Indian corporate history maybe. That again is because of central bank, this time Indian central bank. So I think we are clearly in a new era. That's something, I think the topic is phenomenally correct. That's all I want to say.
Sure. Shankar will come and dissect that point a little more. Let's move on and get initial thoughts of Shankar also in the topic. Shankar, before we talk markets, I remember you once telling me that you also started off your interest in stock markets was from college days, I think MBA days or perhaps earlier. Bulk of our audience today is of the same education background. They're doing MBA, finance maybe an area of interest. Let's start by getting your thoughts on how did you start off when you time? How was information, was it freely available regarding stock markets? How did your interest come towards this side, investing in stock markets?
So, so there was no interest per se because my father was he was earlier, he was a mining engineer, and so he was as far away from the stock market as you can imagine. So our life was basically coal mining and all that back in a small town called Dhanbad. And then when he died, when I was 17 or something, and I was just sitting and was a tenant in a home, called Mr. Siddiqui, and he was filling up IPO forms, public issue bolte the. And I asked him, Uncle, ye kya hai? And he said, Beta, chalo tum mummy se 2000 rupees lo, we'll go to Calcutta and we'll fill up the forms there in the SBI main branch. And it happened to be Asian Hotels IPO.
Wow.
and it was 82 or 83 or something like that. Oh, 2,000 rupees अपने मम्मी से लिया और वो that became some, I think, 5-10,000 rupees in 2 years time. It did very well. So one reason was, of course, that there was no major family income or wealth. So I wanted to get rich quick. And this appeared, maybe there is a force out there which drops something in your lap. And then, of course, the Rajiv Gandhi bull market started in 84, and I was right in the middle of it. I made very stupid mistakes and all that. That is fine. But basically, the groundwork was laid because of the death of my father. I wanted to become wealthy, and stock markets offered that. And this year, if you see, while people have not encountered, maybe people have encountered death also, but really it's been loss of jobs and loss of their businesses, etc., which has driven people to the stock market. So sometimes some adversity can lay the seeds of great prosperity, a few years down the road. So I think in a lot of ways, this year is also similar, that people suddenly found themselves without a job, or businesses collapsing, sitting at home. And just about the only thing you can do with some degree of profit is stock market investing, right? And that has brought in millions of people into this fold of. So it has also become a new era, as Naren said about central banks. It has also become retail investors also driving the stock markets, which, in my living memory has happened, but very, very few times. So that's the other interesting phenomenon that has happened this time around.
As they say, somebody put it, world over, there was a gamification of stock market which happened. And so we'll talk about that. We'll also talk about the importance of self-learning, because you laid a lot of importance to luck also in how much you make in the stock market. You also emphasize a lot on self-learning and digging into subjects. We'll talk about all of that. Neelesh is here. Neelesh, your reputation in the market is of a stock picker, which lays less importance to how the macros are or the environment is, but drill deeper into how organizations are doing and whether they are able to navigate through whatever the environment is offering them. So your initial thoughts, how you go about identifying those managements or those companies which have more hunger than usual. Any initial thoughts on stock picking style?
Yeah, hi. No, I mean, see what we have seen over time, that rightfully selected businesses which meet certain filters of growth, ROI, good management, and reasonable valuation. In a country like India, there are many of those, and they create value, significant wealth, irrespective of the headwinds. And there are certain tailwinds, like Naren mentioned, on the lower interest rate and all, and that has happened almost for the last many years. But at the same time, the country has gone through significant headwinds. I mean, we can talk about our experience. Our first fund was launched 12 years back, pre-global crisis, pre-Lehman crisis, and it has seen whatnot. I mean, seen the global crisis, the Eurozone crisis, oil going to 140, policy paralysis, few government changes, and the Indian economy itself going through a lot of dislocation, whether it is GST, demonetization, and then the once in a century event or so. That said, despite that, if you look at the NAVs of the funds, they have given a return of around 15% or so. Let's say 10 rupee becoming 60 rupee in a space of 12 years. And of course, in mid-cap product, more like in a 10-year period, 7 times or so. That shows that there are multiple businesses in India which can create wealth despite of these headwinds, provided they are able to grow their earnings. And the character of the growth as represented by ROE is value accretive. And now you hold on to that. So we are a very strong believer that in a country like India, where the basic growth drivers are very strong, demographics, potential in infrastructure, digitization, and maybe now probably manufacturing theme, the country itself will double over 7-8 years or few years here or there. Today, the GDP growth may be low. When the growth is such a huge tailwind is there, some of these headwinds can still be met, and there could be many well-managed businesses which could chug along and grow at good earnings. And that would ultimately, stocks are slaves of earnings. And over a period of 5-10 years, if you can find those businesses which could compound earnings in a good trajectory, let's say mid-teens or high teens, then the wealth effect on the stock is also similar. The point is that India is a beautiful stock picker market. India itself is a good sort of market in terms of the growth potential. And there are enough and more opportunities, irrespective of headwinds and tailwinds, to identify stock and create sort of wealth.
Come to that more. Madhu, start by understanding your almost 3 decades in the market. Every cycle you have, of course, one gets better in the game with every passing cycle, but the learnings of the previous cycles also come in handy. We spoke about it briefly earlier. Once you have identified sectors, and then within those sectors, stocks which will outperform that sector. It has been power earlier, engineering earlier, pharma part of it, and now again, you are bullish on pharma, it is known. I want to understand not about any sector, we'll come to that later, but how do you first identify कि ये sector इस cycle में ये sector में more than usual tailwind है? How do you go about that? And then once you arrive at, which are the stocks which will do better than the sector, disproportionately better? Just want to understand your framework.
Yeah. So Ajay, it's a good question. So every time we do it, it is a very different method. But let me just tell you, sometimes it is just the absolute amount of market cap vis-a-vis the overall market cap, which industry or a sector is getting. Let me just tell you, what happened in pharma sector. So when we first originally invested, I was in Reliance Mutual Fund at that time in 2008-9. At that time, the absolute market cap of pharma sector was 1 lakh crore, and absolute market cap of DLF was 2 lakh crores. So it was just not possible, the entire healthcare sector being available at half the valuation of one single real estate company, right? Then that 1 lakh crore moved to 10 lakh crores in 2014. So it was 10x the overall market cap. By then, one Sun Pharma was equal to twice the market cap of all the real estate companies put together. So this is how much life can change. Then from 2014, if I look back, in 2021 March, when the market kind of bottomed, the absolute market cap of the entire pharma industry was only 5.5 lakh crores. So 7 years had passed by. No pharma company made a quarter of loss in last 6-7 years. Still the market cap had halved because of external reasons. So I personally look at, where is the sector positioned vis-a-vis the overall market. That is first. Second, over a period of time, we have learned that, we identified a soya industry also way back, or we identified a granite industry also way back. But, you don't make serious money unless and until you identify seriously good value creating businesses. And it has been my experience that, let's say, pharma, specialty chemical, these are very difficult businesses to build a spreadsheet on. And it has been core of my philosophy of investing. Wherever you can't build a spreadsheet, that is where the big money is to be made. If I look at a steel company or a cement company where I can easily build a spreadsheet, through the cycles you will pay, but you don't make seriously large, disproportionate money. And then the third, of course, we look at, what has happened internationally, how large that sector internationally is. So I go back to my example. If I look at the top 100 companies in the world, I may find 5 or 10 healthcare companies in those top 100, but I can't find, let's say, a soya company in those top 100 market cap or top 100 value creation. So that also plays a big role. And then finally, you look at valuation, you look at absolute profit in the sector. So we do all of that. But the framework is broadly this, but it keeps changing, from time to time. And, for us, I proudly said that I have always followed, and I have no qualms in accepting it, that I'm an opportunistic investor, right? So we have no theory which is permanent. Based on the opportunity, we will make sure that, if the theory needs to be changed of the past, we'll change that theory.
Sure. As Shankar says, if data changes, the view changes. Shankar, you are either just taking a leaf out of being an opportunist investor. You also claim that you are neither, people actually don't understand better, you're neither a bull or a bear. You're a realist. you're an opportunist. And you are somebody who also looks at global trade which are developing, be it commodities, currencies, beyond stocks as well. So when in March, April, bulk of the people are fretting, there was a, if I may call that term, almost a naive community which was buying that day globally. The Robinhood investors, the retail investors, all of that. But there was a big trade in commodities which developed in March, April, May onwards. Were you able to capture that, and how have you developed yourself beyond equities also to target developing trends in commodities as well, or identify?
Yeah, so I think Madhu and I had a chat. Maybe it was end of March or beginning of April, when Madhu was mentioning the pharma opportunity, and I said, "Okay, chalo pharma le lenge, lekin mere ko to oil hi acha lagta hai," which I think was about $17 at that point in time, and it is now a three-bagger, without analyzing anything more than broad logic. So commodities, if you get them right, are like a knife through butter trade. You don't need to analyze it to the extent of analyzing a company or a balance sheet or a stock. You still need to analyze, but not as much as, because they will be moving on a big macro basis. So, but I mean, my belief is that investing is you have to be a total package. It's like cricket, right? I mean, I've been a cricketer, so I like to give cricketing analogies. That let's say you're a pace bowler. You cannot say that I just want a green seaming track to be able to, take wickets. Okay? Because that will come infrequently. You will be given flat tracks. You will be not given, humid atmosphere to swing the ball. You need to be able to deal with all conditions. That's why a Wasim Akram is that great. That's why a Dennis Lilly is that great. Because through different countries, different conditions, different opposition, they have proven their worth. Which means you mastered the tricks of bowling on a slow track, fast track, seaming track, bouncing track, etc. Which is exactly the way an investor should be. That I'm always surprised why people say market acha lagta hai, therefore give me money. I mean, why do you need a bull market to justify somebody giving you money? As an investor, I should be able to navigate every single market, because there is always going to be a bull market in something. And there is going to be concomitantly a bear market in something. So unless I understand the entire jigsaw puzzle of investing, which means global macro, all the pieces meshed together, whether it's commodity currencies or bonds or equities, sectors, I am not a complete investor. So I mean, our goal for decades has been that we need to understand the whole jigsaw, not just say I know one stock or one sector or one country. So that's where the desire came from. And we used to interact with global investors through 90s and the 2000s, and we used to come away thinking how illiterate we were, because those people understood a lot more than us people selling India's story. Okay, because India is 2% of the world market cap. Back then, we might even less than that. So the desire to understand everything came out of a lot of insecurity that यार हमको पूरा game समझ नहीं आता है, maybe अपने को समझना है हर component को. And then of course a sense of inferiority, because global investors had a far better view of the world with no emotional attachment to India or to America or whatever. So, and I do believe to be complete in investing, you need to understand the entire jigsaw. Okay, that's not to say that you cannot be successful as a bottom of stock picker. You can be. There is no debate on that. But that is a very different approach. Our approach has been that understand the big picture and from there drill down to buy that one great stock in one great sector. So again, I always say there's a different path to heaven. Investing is not like only my method works and Madhu's method or Naren's method or method. Everybody's got a method. They're all very successful people. This is our way of doing things.
No, sure. I completely agree. And I really appreciate that it's humble of you of admitting that at various stages of evolving as an investor, one recognizes that there are things we don't understand. Then only there is scope for additional learning. Let's talk about that a little more with Naren then. Naren, you have always been somebody who have been a votary of identifying cycles, following cycles because they repeat. And when this time round, central banks, as you've studied them very closely and their actions on the markets, when this time central bankers approached this crisis, which was actually an external crisis and a health crisis, not really an economic crisis, and you have seen central bank action, global central bank action in the past as well. Did you realize that this time also they'll go all guns blazing? Were you able to get something and fast or loaded up, or were you observing that how will they go, and liquidity will be much more than in the previous instances?
Actually, there is a piece written in Levy Forecasting Institute. There is a piece called Bubble or Nothing. It's free for anyone to read. You can download it and read it. It's a document which has been co-authored by an Indian, actually, sitting in New York. That piece says that, I read that piece in 2019, and that piece said that if such an event were to come, the central bank will go all guns blazing and do whatever it takes. And exactly like that they did. And that's one of the reasons, including on the ET Now channel in March, we gave a call saying that put all your money today in equity. And that was a call we gave in March in the ET Now channel, which turned out to be an accurate call. That was primarily built on this research piece, which was so accurate that they said that central banks today cannot afford a market meltdown. They need the markets to shoot up. And they will do whatever it takes. And this was the Ben Bernanke model, which had been created in 2008. So it was actually a very, very easy call in March 2020 that you will have a bull market and a massive bull market at that point of time. So that explains, and that was a very, very easy call to make in March 2020. Frankly, we had funds which were asset allocation funds. We got a massive opportunity to buy in March 2020. So it was too easy. But that is then. Today, what do you do? Because markets were very cheap then. They were dirt cheap at that point of time. But today, you are actually not in that environment. That is a task. Because at that point of time, it was too easy, and now it is not that easy. Because now, actually, you are not at cheap valuation. You are no longer in crisis in the market. You are overvalued on conventional valuation metrics, but the economy problems have not been resolved, but the markets are overvalued. But even today, because oil has not reached $60, you continue to think that markets will continue to go up because inflation hasn't come. That's the situation today. So from a cycle perspective, we seem to be waiting for inflation to come back in the Western world for the markets to actually correct, because till the day central bank comes and says, I want to withdraw liquidity, the markets can keep going up. Unfortunately, no one in India would know what is that point at which the central bank will decide that I have to pull out liquidity. But till that point of time, you have actually markets going up because there's so much of liquidity in the markets that there is no way but the markets has to go up, because you can't put money in debt, because that gives you zero interest rates or negative interest rates. Or otherwise, in India, you can't put money in Bitcoin. Globally, as you know, people are putting money in Bitcoin. You should see the way Bitcoin is going up globally. It's gone to 23,000 from nowhere. So you have a situation where a product which can't be valued, where there is no way in which you can get interest or dividend, like Bitcoin, that is a product which is shooting up like a rocket. So that is the kind of liquidity-based bull market that has been created. It will last as long as liquidity is pulled out or interest rates are increased.
In fact, one of somebody who you follow very closely, Howard Marks, says that the three most important words in the market are margin of safety. Do you find margin of safety in this market? Does that become a challenge to run such a big fund?
See, actually, there has been huge margin of safety in value stocks. Relative to the market today, the interesting thing is there are so many companies in India which were borrowing at interest rates lower than their dividend yield. Even today, after the 25% move in many of those stocks, the borrowing rate and the dividend yield are same. 2 months back, the borrowing rate was lower than the dividend yield. Today, the borrowing rate and the dividend yield are similar. So when you have such huge margin of safety in those stocks, on those stocks like value stocks, you actually have a very, very comfortable situation that you have a huge margin of safety in neglected sectors, value stocks, etc.
Naren, let me interrupt. Does that not become a challenge when you manage other people's money? Because margin of safety, which is value, may underperform for a long time where you get questioned. So perhaps that becomes an issue when you can take that call on your own money. But when you manage other people's money, does that become an issue?
For everything, it is a challenge, frankly, because when you manage other people's money and buy a stock which is going up every day, just because it is going up every day, tomorrow you will be answerable when it falls down, just because it is falling every day. So today you are not, you are answerable on a value stock because it is not going up and not because there is margin of safety. There is margin of safety in a value stock, but you are comfortable because there is value. But tomorrow you'll be answerable in those other set of stocks which are going up every day. And we've seen that in 2000, because if you recall both 2000 and 2007, the set of people who bought tech stocks in 1999 and the set of people who bought construction stocks in 2007, they got into trouble in 2001 and 2008 because those construction stocks and technology stocks, when they crash, people ask the same question. So when you're managing other people's money, there are always challenges. But finally, after spending 6.5 hours watching Harshad Mehta on Sony Live this year, we have to be very clear that the very people who will call you God will soon call you liar. So it is wise for you to be sensible and talk and do sensible things on a continuing basis when you're managing other people's money, regardless of how people look at it today, because that is the lesson you learned by watching 6-7 hours of watching Harshad Mehta on Sony Live this year.
Well, that's one of the most talked about movies for sure. Of course, that's how you last so many decades in the kind of position you are. Neelesh, talk to us about your learnings when the market for months was so narrow. A very small set of stocks were moving ahead. Obviously, the liquidity first came there, or safety, you may call it, whatever the reason might be. But for a prolonged period of time, the market became very narrow, almost difficult to explain why. And now there are early signs that liquidity is broadening and other stocks are moving. Because you've been a stock picker. If you chase those 8-10 stocks, then you are in trouble. Or how did you navigate that part?
You're on mute.
Neelesh, I think
you're on mute.
I'm sorry about this. Yeah, Ajay, so there will always be phases where there is polarization, some trend is working, etc. See, what is important is we have to see and dissect how wealth is created. And as I mentioned earlier, there are few filters, and if you stick to the basic of those investment, then over time you select a right set of businesses, they compound earnings, and you make money on that. As Benjamin Graham once said, that investment is most intelligent when it is most business-like. And Buffett once commented that these are the 9 most powerful words ever written in the history of investment. A lot of substance in this simple sentence. See, basically, you need to take a business-like view while investing in any stock, which means you have to analyze the 3 important buckets of character of the business, the competence of the management, and the valuation you are paying for it. There is to be grid for that. Let's say growth businesses, good ROC, management which has integrity, intellect, energy, and a margin of safety between price and value. You have to buy only when the value is more than price. With that grid and a diversified portfolio is what we aim to construct. There could be a period where there could be either polarization, there could be tailwinds, headwind, irrational exuberance. All that is a part of the game which is not in our hands. Many of the macro trends are not in our hand. What is in our hand is to understand the nuts and bolts of business, buy businesses, not to fall in value traps by buying something which is not growing and not ROC something. At the same time, not to go to the other extreme of buying something which is beautiful business, good ROC, extreme good growth, but obscene valuation. And there are many names like this. So the point is, in middle way, we have to identify the right set of businesses. As I mentioned, double-digit growth, good ROC, good management, reasonable valuation, and make a portfolio which is risk-adjusted and just hold on to that. Polarization is a function which is driven by market forces. I mean, there could be a period where few sectors are in favor, out of favor. But over time, I have seen that when you look at a return over a 5-10 year period, the basic discipline of identifying right set of businesses and avoiding the too extreme, not buying good businesses and overpaying for extremely good businesses. This discipline and sticking to that helps identifying a good set of companies which over time create wealth, because as I mentioned earlier, and on just for the repetition, that returns are nothing, but they move in sync with the earnings growth. So, I mean, I've given an answer more on philosophical side that how to manage polarization, but that's the construct we use, whether there is polarization or there could be flavor of the season, etc. We stick to that basic discipline of identifying a company from a 3-5 year perspective.
Madhu, your style over the years has also gotten into, identifying or at least taking a bet, whether they fully fructify in that or not, only subsequently one comes to know. But beyond Excel sheet factors, when you meet the management, when you see a style of leadership, what are those things? Or if you could, what would that do? Identify those kind of companies.
Ajay, we could not hear you properly. Can you just repeat it? Because in between you got interrupted. I think you need to log in again.
I can't hear Ajay.
Yeah, I think he logged off and log in again.
Ajay sir has dropped off. He'll join in a minute.
Yeah, we have him back.
Hello, Ajay sir, are you there?
Yeah, I am here. Can you hear me?
Yes, we can hear you.
Okay. I'm sorry. Yeah, sorry, got disconnected. Yeah, sorry, I got disconnected. Okay. So, shall we start?
Yeah.
Okay, yeah, Madhu. So, yeah, sorry, I'm on vacation, guys. I didn't want to miss this opportunity, so joining from my hometown. Internet is slightly weak. Madhu, I wanted to understand your gist of all the experience now you're putting applying for your own, investing venture, where you can take perhaps more risk, you're not answerable directly to other people's money. What निचोड़ क्या है आपके 3 decades का? Share some learnings on how you are identifying managements now.
So Ajay, I give a slightly long answer to this.
Sure.
पहला निचोड़ तो ये है that we are so blessed and so fortunate to be part of these beautiful markets that, just imagine if I was a mechanical engineer, where I would be for 30 years working. I think, so I feel blessed, and it was only a matter of chance. So I have one very strong message to all the students who are studying or who are wanting to build a career in financial world. If you are passionate about it, do not rethink. Because what I thought 30 years back while entering this market, it still holds true, Ajay. Because see, I am a son of a very, very poor farmer. My father could not afford to send me to Mumbai to study, and at that time to dream and to be where I am today, fortunately. I thought that time this is a market where you don't need to be son of Tata, Birla or Ambani to be successful. You don't need really much of capital. Even 1,000 rupees startup capital will work. Thirdly, intellectually, you will be very, very satisfied, because all the time and later on, that belief got even more reinforced. ऐसा कौन सा धंधा है जिसमें आप एकदम टॉप ऑफ द टॉप क्रीम डे ला क्रीम से डिस्कस कर रहे हो, कभी किसी सीएमडी से बात कर रहे हो, कभी किसी इंटेलेक्चुअल फंड मैनेजर से बात कर रहे हो, तो इट इज इंटेलेक्चुअली extremely satisfying, and these are no boundaries where you can reach. So I would say that the first learning is to be part of this market, and my message, as I said, to all my fellow students and people who are studying, that if you have chosen this path, don't look back, do with passion and hard work, and there is a lot of success ahead of this. So I didn't know whether you would ask me this question, so I just made sure that I answered this. So that's the other point. That the zest is,
send a message to them.
Yeah, the zest is, as Shankar said, that there are many ways to this heaven, and each person would have their own style. So I strongly believe that if I copy Shankar's style, I may not have one of my own, and I'll fail to copy that as well. So it is better to be a mediocre successful person, following your own conviction and following your own set of rules which you have set for yourself, rather than trying to copy someone. Like, just imagine, I can't copy Warren Buffett in this market, because Warren Buffett has a problem of plenty. He has to invest billions and trillions of dollars. I'm not investing billions or trillions of dollars. So you have to have your own thesis. So the thesis which has worked for me is, A, you identify a great business. Over a period of time, we have got more and more wiser at that. We committed our share of mistakes, and we continue to commit. I will say that the good news is only that we are committing fewer of them now, as compared with like what Naren was saying, that in 2007, because we were a fund house, we launched an infrastructure fund at that point of time, because money was available and we did not know how it is going to shape up. And obviously investors lost a lot of money, and there was a learning out there. So you essentially try to identify a great business. Within that, I pay disproportionate importance to the entrepreneur and the management team who is going to drive this. And again, this is something which has worked for me both ways. Even in terms of learning, sometimes you bet on a very aggressive person, and he takes disproportionately aggressive bets, and you suffer as an investor. So now we have refined our own process, that we have to have a mid path, but still the management and the management team plays a very, very important role. Third point is that you have to develop a mechanism to track your best ideas and best investments. Let me tell you, Ajay, let's say if I didn't do anything in my career and just stuck to my original investment of Divi's Lab, I would be far richer, far more successful, far more renowned. Nothing I had to do, because that company has become 650 times in matter of 16 years.
Wow.
So what I'm trying to say, we have to have the tracking mechanism to track our winners. And there will be a lot of volatility in between. And the conviction which you bet on a company, see, buying a thing is very, very easy. Not being able to sell when it goes 10 times, 20 times, 50 times, and continue to track that becomes a tough job. And I must tell you again, the real winners in the real good companies are very, very few. There are transitory multi-baggers, but the real multi-baggers where you can really put disproportionate money and you can put a lot of faith are very few companies. And the fourth thing I would say that, you have to have the courage at a point of time when you will invest in a company. Trust me, 95% of the time you will be a loner, because if there is a consensus when you are investing, by definition, it won't be a great idea. And similarly, when you want to sell, at that time, you have to again be a loner, because you will only be able to sell a large position in the market when things are really good and they are really looking up. So when the decline happens, it becomes very, very tough. So I think combination of these factors, but most important is that you have to have your own thesis, your own approach, and follow that.
Sure, fair point. Let's take that point further, Shankar. You are somebody who also puts a lot of emphasis on learning, self-learning, finding out areas which you are weak at, plugging the gaps. And that's how you move towards tracking global markets, or at least diversifying some part of your portfolio. Now you're also talking about Indian HNI investors should also think in the same direction. But because a lot of students are listening, how would you share with them the importance of your learning mechanism? Still, you are reading every now and then, you're quoting newer things. And because learning and making money in this market, what I understand from all of you, goes hand in hand. One can never say, I know enough. So if you could share your experience of your learning framework and how to keep yourself skilled in this area.
Right. So, I'll just share with you, just recently, this is like, I think 4 months back, the lockdown, I've got a huge, library of physical books up, it's all on Kindle, but, through the 90s and the 2000s, like really thousands of books, in my home. So in fact, when we were planning to shift from Colaba to another place, one of the reasons why we decided to shift was because we were running out of space in our Colaba flat. यार अपने को बड़ी जगह लेनी है क्योंकि अब किताबों की जगह नहीं है घर में. So it was not that we needed more bedrooms because it was a small family. It's more really to accommodate the growing number of books, and we had a budget every month that back then I'm talking about 90s, that we have to spend 10,000 rupees per month on buying books. So and we can only exceed the budget, we cannot undershoot the budget. So 10,000 तो करना ही करना है, उससे ज़्यादा भी कर सकते हैं. So and then just 3-4 months back I said, यार चलो वापस. And the other thing that we put in place was we have a very extensive library software so that we know on which shelf which book is there. Otherwise, yaad nahi rehta. Sometimes we ended up buying multiple copies of the same book because one had forgotten that one had them, previously. So we put it in a
physically. You make a note of which all books you have and where is it kept in your entire, as in like an actual library.
Wow. Every shelf, every book, I know where it is because it's all on a software. Otherwise, it's impossible to figure out. रात को भी यार ये किताब पढ़ा था quantitative trading mechanisms का, अब वो कैसे यार बोल आपको 5,000 किताब में कहाँ जाके खोजोगे उसको. So we have a very, very nice system. Every book is in its proper place. So I went to that library because I checked up on this thing that यार मेरे को ये 3-4 किताबें पढ़नी है वापस. I want to revisit the quantitative trading mechanism because today our strategy of investing is completely different from what it used to be 25-30 years back. So then I went, I found the books, I brought them up to my bedroom. They were big fat books, and I started reading them after I think a good 25 years because these books I had we had bought in 95-96. went back and reread them, and now with greater experience, one was able to take out things which one had not been able to back then. So this is a business which is so intellectually driven. From those books, the wisdom comes, and from that the money comes. I mean, it's a never-ending journey, and therefore, the other thing is, with greater wisdom, greater experience, your outlook also changes. So, the way one used to approach investing back in the 90s versus what one does now is like a night and day. I always believe that it was an art, okay, because that's what one reading Peter Lynch and Warren Buffett and all those people told us. Today, I mean, my belief is that is nothing but a statistical science. There is nothing else to investing. Again, I'm not being dogmatic. Like I said, there are many paths to heaven. Okay, I have no disagreement with that. My learning is it is nothing but a statistical game of science. It is not about art. It is not about anything else. If you want to, really understand many different aspects of investing, that is the only way to do that. The other thing is, talking about on the global side, we started to build our global understanding and capabilities from 97, 98. Again, that came out of the Asian crisis. It came out of a crisis because we said, यार कि अपना सब पैसा इंडिया में ही पड़ा हुआ है. अगर इंडिया डूब गया, जैसे कि सिंगापुर डूब गया और मलेशिया डूब गया और इंडोनेशिया डूब गया, इंडिया में इतने कौन से सुरखाब के पर लगे, ये भी डूब सकता है. अपनी तो हालत वैसे भी खराब रहती थी हमेशा compared to all the Asian tigers. So we must diversify our business. We must diversify our investing and start looking at global markets. It was very tough because understanding companies of global size and scale, balance sheets होते हैं encyclopedia जितने, वो बैठ के समझना, subsidiaries 100 subsidiaries होती है, accounting होता है. It's a mess, I can tell you. I mean, compared to Indian companies, global accounting itself used to be a nightmare. But that expanded your mind. It was like going to the gym. It's a mental gym. Your brain expands. You build muscles in your brains. And we reap the rewards of that today. 20 years later, we reap the rewards of those endeavors that we started to put in towards the late 90s. So I know to the students, and the reason why I'm mentioning this is because I assume there are largely students watching this.
Yes.
This is a game in which really amount what you put in, you will get 100x back without any doubt. इससे ज़्यादा I think input output का disparity मेरे हिसाब से कोई और business में नहीं. But the fact is, the other thing I must caution is that this business also exposes people with shallow learning and shallow knowledge. Okay? So that's the other thing. इसमें पकड़े जाते हो, इसमें चोरी पकड़ी जाती है, इसमें आपकी शैलोनेस पकड़ी जाती है. बाकी बिजनेस में फिर भी काम चल जाएगा आपका. इस धंधे में you will be exposed, your frailties, your mental models which have gaps. This market will ruthlessly expose it. It's like, again back to cricket. If you're up against Wasim Akram, he will expose your lack of technique. Like India's lack of techniques has been exposed today and yesterday. Okay. So
Shankar, the other thing which I know of you is a lot of people, you make a lot of people nervous as well, is that the way you shoot holes in hypothesis, a general hypothesis or a popular hypothesis. How do you shoot holes with them? Also, I know you brainstorm with your friends, Madhu, and you hang out a lot, discuss stocks, sectors, markets. How is this game also important to develop great relationships between your friends, where you hang out, discuss complicated topics, dig holes in each other's hypotheses? Tell us about all of that, because again, the universe which is watching us, a lot of friends, they should know it's a long journey. You need to have great friends who can not only guide you, but also dig holes in your hypothesis and common learning together.
Oh, absolutely. I mean, this is the fun part of this business, right? That to meet very, very smart people, very intelligent people with very different approaches to what your approach might be. And this business teaches you not to be dogmatic. So a Madhu's approach is absolutely, of a different, kind. Which, and I do believe he has got some very, very interesting experiences of how he stumbled upon divvies and all that, but they make for fascinating, listening and hopefully reading at some point in time. But you build friendships, you build relationships, and there is no competition because there is so much opportunity. यार आपको ये लेना है ले लो, मेरे को वो लेना मैं ले लूंगा. ये कोई थोड़े है कि there is only one stock that you all need to buy or sell simultaneously. So this world is awash in opportunities, and when you meet people who are more accomplished than you, who have got greater width of experience, breadth of experience. Like I said, for me, one of the biggest perks of being on the sell side was the ability to meet a wide cross section of fund managers, not just in India but globally. So I've met, you name it, the who's who, and dealt with them over decades of doing sell side. And with each you learn something, with each also you unlearn something. So it's not as if every global investor is very smart. I've come across some people who are very dodgy in their approaches. It's just a beautiful experience to just, absorb things. Even today, I have very good friends on the buy side, even though I don't have no interest in broking to them. And we debate, we discuss every single day. We curse each other. If I buy his tip and it goes wrong, it's just great.
Great. Naren, if I were to ask you, your own version, this book, The Most, is actually was triggered. A friend of his actually told him, you've been writing memos for such a long time. Why don't you put it in a collection or something like that? But Naren, if I were to ask you the most important thing, what will your own version of the most important thing would be in investing as a subject?
I think what we have learned, at least from the mutual fund side and from the point of view of 98% of the investors and ignoring the 2% of investors who are above that 98%, is that if people practice asset allocation in a sensible way, 98% of the investors are taken care of if they just practice asset allocation sensibly. It is only for those 2% that something above that is required. And that 2%, maybe they own 20% of the assets, maybe that's okay. But 98% of the people, for example, just simple asset allocation would be sufficient. And that asset allocation means that you buy a undervalued asset class, buy an asset class which is done badly, sell an asset class which is done very well. And that, I believe, is the basic principle, I believe, which has worked. If you ask me otherwise, as a framework, if you ask me, we have been using a framework which is, we use valuation, we use cycle, we use sentiment and trigger. These framework of valuation, cycle, sentiment and trigger we have been using. See, for example, NBFCs were in big boom phase, but till the day ILFS failed, NBFCs continued to boom. Real estate was a sector which kept on doing well. But till the day Dr. Raghuram Rajan increased interest rates in August 2013 by 3%, the real estate sector kept on doing well. So the need for a trigger to change cycles is very, very paramount. And that is how, for example, the Indian equity market revived after Modi got elected as Prime Minister. So I believe that basically there is a need for a trigger. So we've been using a 4-point framework called valuation, cycle, sentiment, and trigger. And that framework has kind of helped us over a long period of time.
So where are we right now in the market on that matrix of yours?
On that framework, it says that the day the central bank, the US central bank decides that we have to tighten or increase interest rates, equity markets is due for a fall because valuation is not cheap. The cycle in US is overextended. Sentiment towards equity is also getting increasingly more positive. But there is a need for that trigger. That trigger has to come out of US central bank. So till the day the US central bank is dovish, things are fine. But the day the US central bank says that I want to tighten, we are headed for a fall. But that could be years ahead, could be. So it's not that we can time a US central bank trying to tighten. That is what it comes at this point of time. So we are in a boom at this point of time. On the other hand, an asset class like residential real estate, we are at an interesting point in valuation. The cycle is also done. Sentiment is just about improving. So if you look at the residential real estate cycle, we are at a very different end of the residential real estate cycle.
Is it looking attractive to you?
Yeah, it is looking much more attractive to us.
And which areas are you looking?
I'm not so knowledgeable on that area. I'm much more a macro person there than a micro person there.
But which areas look frothy in the cycle?
The most frothy at this point of time is debt, particularly global debt. Global debt is very frothy. I would tell people what is the point in investing in short-term AAA debt instruments. Today, that is but it's beyond what most of the students would be investing in.
But India,
no student invests in a commercial paper carrying 3% interest rate or invests in a AAA bond of 3 years carrying 4.5% to 5%. But those kind of products are most frothy at this point of time, along with all the, these Tesla and those kind of stocks in America. So you know how Tesla and all those Airbnb kind of stocks in America, which luckily we don't have to invest in. Those
but
all also look
in India.
frothy.
In India, what is frothy?
In India, I don't think anything is as frothy as what it is in America, but I don't think the quality stocks in the large cap space are cheap at this point of time. They look fully valued, but I won't say things are as mad as Tesla and those kind of things which you see in America. I think that kind of thing is seen much more in America, because America has seen in the 8th year of a bull market. India has seen so many intermediate corrections in this phase that we are not in a 8th year of a bull market at this point of time. We've seen so many
I'm sure
corrections.
we'll get there. Madhu, can we get there can we get there in a couple of years? 8th year of bull market.
So
we don't know whether off on a long phase.
So my views are very clear, Jay, on that there is still in India, there are lots of sectors and bottom-up opportunity. As Naren was rightly alluding to value stocks. And in my opinion, HPCL buyback was kind of a small trigger. For the first time we have seen in the history of India, our government, that a government company is buying back its own shares. I have not seen that in my career. I don't think it has happened in the last 70 years of our independence. So I think that there will be corrections. There is no doubt about it. When you go from 7,500 to 13,500, 14,000, there will be corrections. But I think these markets have still legs when you talk of individual companies and when you talk of individual sectors. Because let's not forget, what is the alternate today? That if you put your money in 3.5% interest rate, which is what the banks are offering, or if you put money in fixed income, where you are literally not making any money. And this is more of a psychological and a greed and fear game, rather than any realistic game, or rather than it being something which is true or false. Because if your neighbor is making money every day and coming and telling you stories that I bought this stock and it went up this way, I bought that stock and it went up that way, then it is so difficult for you to continue to hold your cash at 3.5% interest rate. So if I look at that cycle, I don't think that the world in large has yet participated in the market. People who I speak to, they are still cautious. And you're talking of, markets being frothy. Something like a State Bank of India is still available at 30% cheaper price than what it was available, let's say, in March or January of this year. So I think there is a section of sectors or markets where you can see the valuation or stretch, but I don't think the overall whole market is frothy.
Nilesh, when you go about meeting individual companies, you're active as an active fund manager, especially from the mid and small cap side. What has your experience been in the last 6 to 8 months? How have small mid cap companies navigated through? Some of the names have done phenomenally well. As we were discussing offline, over 200 companies have already risen more than 100% in the last 6 months in the mid and small cap side. Some examples, if you could take, how balance sheets have been cleaned up, how efficient managers of businesses have managed their businesses in this crisis in the last 6-8 months.
Yeah, I mean, if you look back, particularly in this short period of 6-8 months or almost a year, I mean, the mid caps and small caps have done extremely well. The mid caps index is up 18%, small cap index is up 14%. About almost 225 stocks are up anywhere between 20 to 200%. So you're talking about polarization, which was earlier. I think it is absolutely not there. It's got blurred, and the rally is very well sort of diversified. And many of the businesses, it doesn't look like a pandemic year if you look at 1 year return. I mean, 1 year back, there was no pandemic. So to that extent, it's been fairly broad-based rally. I think probably two things could be because of this. One is I think at a macro level, very quickly, we think that India is at the cusp of a multi-year growth cycle, given low interest rate, which has a bearing on demand, cash conversion, P multiple, given what's happening on housing, which Naren touched upon, given the fact that Forex is one of the best situation. 100 billion got added in the pandemic. We have current account surplus after 17 years. Rural, we are seeing strong buoyancy back-to-back good years. And this entire China plus one plus the PLI or whatever the Atmanirbhar campaign is gaining traction, which could be an additional pillar to the recovery. So we think that from pre-pandemic, which we were not doing well, to post-pandemic next 3-5 years, there can be significant growth. And whenever we see a revival on the growth, generally the markets are not polarized and you will have much more broad-based rally. In terms of your sort of the second part, I think probably when in mid caps compared to larger cap, you need to have much more aggressive filters. So let's say when I talked about growth or ROI, the filters should be slightly more stringent in mid caps. If you are happy with 13-15% growth in a larger company, then for mid caps, one should set a 18-20% longer term growth potential. Same goes with return on capital employed. And most important is the management aspect, which Madhu did touch upon. I think mid caps are yet to see various filters of various sort of cycles. So to that extent, you need to put much more stringent filter in terms of evaluation of management. That's extremely important. So I think the core template while buying a larger set of business with proven track record or a smaller set of business remains the same of growth, ROI, management, and good valuation. It's only in case of mid caps, because of liquidity risk, because of lesser track record, you need to be much more stringent and much more careful in doing due diligence, much more channel checks, etc., while investing in mid-sized businesses.
Neelesh, there's a view in the market that 15-20 year period when we're analyzing the mid-cap basket or smaller cap stocks and the larger caps almost make the same kind of returns. But when we analyze it in a relatively shorter periods, 3 year, 5 year, 7 year, the data shows that mid-caps there is higher probability that mid-caps can outperform large caps with a factor of more than 1. What phase of the market are we in? Over the next 3 year plus, where do you see margin of safety and better chances of return in the large cap basket or mid cap basket?
No, given that what I mentioned that there's been a strong uptick in mid caps, I think it is a normal phase. By normal, I mean everyone can have a different view. Our view is that one should have higher allocation to large caps in India. Almost 2/3 to 3/4, about 70% should be in larger businesses, 25-30% should be in mid caps. The reason for that is large cap in India are still, they meet the filters of growth and ROI. Indian economy itself would double over a period of time and will reach $10 trillion. I mean, the years can be debated. That means many of the stronger franchise, they have a huge headroom to grow. They have superior return on capital employed. They have much better management bandwidth. So it's very unlike other geographies that you're compromising on any of the basic traits of while investing. That's why we think that where the country currently is, almost 70% should be in larger caps, 25-30% could be in mid caps. I mean, there is no significant discount to mid caps as we speak. Some of the names which were mentioned during the debate and the value pockets and all, most of them happen to be again in larger cap space. So I think a large portion should be in larger cap and maybe about 25-30%, which is much more bottom up oriented. We can't paint with the same brush all mid caps. I mean, there is a huge divergence in return. So that much about a quarter should be in mid-sized businesses.
Shankar, for the benefit of our viewers as well as audience, what have you been reading or researching lately? What is the call which is being processed in your mind, which is still not out there widely? Some differentiated call which you've been processing, or your thoughts about the investing environment, be it commodities, stocks, or even forex or geographies?
No, so I mean, basically, it's I mean, as far as one's thinking and is concerned, as I mentioned that, if I look back from 30 years back to today, just gone completely 180 degrees. That today, I as an individual, we as a firm, we believe that there's no point in meeting a management. Okay, कोई फायदा नहीं है, waste of time. You can't build size and scale. एक एक कंपनी से मिल के उनको बॉटम अप पढ़ के बहुत सब किया हुआ है, ऐसी बात नहीं कि नहीं. I mean, that's again our belief and our journey, that you don't need to do all that to make money. It is purely a statistical game. If the statistics are right, you are by and large going to beat the market and beat it handily across most periods. Okay, there will be occasional pockets in which there will be you will lag or whatever it is, but by and large you're going to solidly beat the market using a very, very mechanical and statistical approach. So that, and to that end, every single day we are looking into data, going deeper into data to understand that phenomenon. And every day, like between last week and today, some newer discoveries we have made in our own mind. Maybe it's already out there, but we are fools. So we are discovering things. It is a fascinating thing to find that how much, जैसे बोलते हैं कि कितना गुमराह हो गए ये वॉरेन बफेट पढ़ के. मतलब actually ये ज्ञान 30 साल पहले मिला होता तो net worth would have been 100 times more. I can tell you that much.
So have you formed an algo? Have you formed a program where you filter stocks globally, or what is that mathematical formula which you are developing, or some shade of that?
So we have done this for a long time. Okay, so it's not as if it's something
No.
new. So we have done this for a long time. And like I said, everything is a journey. Nothing is finite and perfect. Even today, we are not satisfied with certain things. We are working on it and we'll keep improving it. And newer information, newer and newer approaches. Last night, I had a long call with our guys on the ML side. We discussed many, many things. So again, remember, we are old school. All the people on this call are old school. We are all similar age groups. We all started at the same time. We are in a lot of ways. I like to call myself a fossil, a dinosaur. Okay, the world is changing. And if we do not change, we will be rendered useless in the world of the future. Okay? Therefore, I want to be current. I want to remain relevant. I don't want to remain, old in my thinking. So I like to speak with people who are younger, 20, 25 years younger than us, who are teaching us things. Maybe they don't understand the cycles or the psychology of investing, but the tools, they are far better. I need to understand that. So I am making myself very relevant every single day. Every single day. So that, again to students, please don't think you have figured it all out. Please do not think so. This is business where newer things keep changing, newer things keep happening. You must remain current. You must remain relevant. It's like you're making a car which is internal combustion and electric vehicles come and suddenly your business model is gone, right? That's what will happen and is happening to the fund management business model. Okay. I don't want to be in the dinosaur category. I am a dinosaur, but I'm changing myself.
Shankar, say that there are bold traders, old traders, but there are no old bold traders. So you are an old bull trader. You can go long on Tesla even now.
No, we own it. I mean, so, with all the caveats Naren mentioned, so, and I respect that. I have no disagreement with that.
Yeah, sure.
But, I am a big believer in bubbles. I've always played bubbles. I love bubbles because bubbles are easy and free money. The difference is that, in the 99, 2000 bubble, we played it. I mean, I think the biggest money I've ever made in a single 2-year period was 99, 2000, where stocks we bought went up 20, 30, 40, 50 times, which I don't think will happen ever again in my life at least. But, we saw the bubble coming, we exited. Same in 2007, we had all the infra companies. So I just like to believe that we will dodge this bubble also, if and when it ends. But I agree with that.
Do you see a case building?
Sorry?
Do you see a case building for a bubble anywhere, or how far are we from a bubble in any? If you could just to understand, what is your view on how far are we on the journey? Is there a case for a nice bubble building anywhere?
Yeah, so we did some analysis on the 99, 2000 tech boom and this current tech boom, and it was revelatory that most companies, and if you look at the aggregate of global tech, not just US tech, are far better in terms of margins, profitability, and even cash flow, by the way, as compared to 99, 2000. I mean, frankly, it's a huge change. The other big change, other and very, very, very important, is interest rates were 5-6% back then, and they are 1% now. So, rest everything being equal, valuations have to be higher today than they were 20 years back. So, interest rates are 80% lower, 90% lower. At the same time, quality of companies today in tech globally are way better than what they were in 99, 2000. And I just want to allude to one fact, which is that I think investors overall, not just us, but everybody is we are all becoming more mature in our ability to analyze good and the bad. So I think globally, bull markets are becoming better quality bull markets. You are not going to find all kinds of junk going up. Okay. This year, frankly, I can tell you, in my entire career, this has been the easiest 9 months of making money because it was easy to get the trade, and every single company that has given you 50, 100, 200, 500%, not just in India, globally, every single company I can justify why those numbers have come. Every single one of them. This is very different from 99, 2000, where we made a lot of money, but there was no justification. Okay, or 2006, 7, when buying all kinds of crap infrastructure company. This time it has been a very logical bull market. That's not to say we will not correct. I think we should and we ought to correct. A 70% rally with not even a 5% correction is unheard of. Okay, it should, and it will happen when we least expect, but it will happen for sure. But I don't think there is any end per se that I can see to this current bull market. I don't see that.
So, okay, Madhu, we know how you've done some deep work on global healthcare, Indian healthcare. That's an area of interest for you. Share some thoughts on that side and how this time, it is a much bigger, broader trend overall, which is unfolding there, or any other area which you've done, deep work on and you would like to share with us.
So I think we continue to remain positive on the sector with a caveat that making money in a healthcare and a pharma company is very tough, trust me, because you have to really understand, and something regulatory goes wrong, then you literally have to either wait for a long period of time or lose 2/3 of your capital, which has happened with best of the companies in the sector. So where are you in that cycle? So when you are investing in any healthcare pharma company, the most important thing to look at is what is my margin of safety. If something were to go wrong, how much money actually can I lose? So that's, but I think companies are still cheap, specifically some mid-sized companies where we have made investments. They continue to remain cheap. And I think there is still money to be made. The other, just, we talked about sector and much has been spoken. Again, when you look at some of the neglected sector, just, I'm not recommending this to buy, just to prove a point. That's the entire market capitalization of the entire infrastructure sector today, X of L&T, is less than 50,000 crores, which is possibly half the market cap of Pidilite. Just putting in the context, right? There are at least 30, 40 companies. Or similarly, real estate. We have had Naren said about 2013, but I think this bear run is going on since 2009, at least in the stock market. What the prices which we saw in 2008-9, DLF used to be 1,250 rupees. And after 13 years, with no bonus or split, it is available around 200 rupees. So the absolute market cap, if I look at the whole real estate sector, has become quite attractive. So now, is this reason enough for you to go and buy? No. But is this reason enough for you to do a lot of work on individual companies? Yes. So we are looking at some of these sectors very carefully. Similarly, let me tell you one important thing which happened, that the government came up with a PLI scheme, and they are saying that we are going to give you roughly 2 lakh crores over the next 5-6 years. Now, if you give 5% PLI and you are going to give 2 lakh crores, which means there has to be a turnover of 40 lakh crores on the manufacturing side, right? For me to get 5%. Now, if I have 40 lakh crore rupees of incremental turnover or 30 lakh crore rupees of incremental turnover, I am sure there will be opportunities in these sectors. So, as I said, Ajay, we remain opportunistic and don't get married because I like a particular theme, so I have to make money on that theme only. So we are continuing to look at opportunities, and today I feel a little fortunate because the amount of money is small. You are more nimble and you can move, very quickly here and there. So
right. No, thanks. Good that you share your thoughts so candidly. Madhu, you think sector that you have on radar. Then, of course, it's on individual investor how deep they want to go and find out names. Let's talk about. Let's go to questions now. Professor Punjabi has indicated that we need to ask all our panelists about. Neelesh, let me start with you. One key learning of your entire career as a professional fund manager in the market. One key learning or one book which influenced your investing framework.
So, I mean, there has been multiple learnings. I would say that errors can be dissected into two buckets, errors of commission and errors of omission. I think more important for institutional framework sort of money making is more on the errors of omission, just to analyze what went wrong. But I think most of the earnings, the central thread was either we have compromised on character of the business, which is, let's say, buying a low ROC business. I am quantifying it with one single factor because that includes everything, moats, entry barriers, etc. So if you're compromising on ROCs, growth, management quality, and valuation, all our errors on both the fronts are linked to compromises or on any of these front. So that's on the sort of learnings in terms of, and it's a regular process. It's a journey, as you said. We try to, as someone else mentioned in the panel, is that what is important in this profession is not to repeat the same set of errors, or probably to reduce the intensity of the errors. So that's on that. I think broadly, I've been follower of old school thought of Benjamin Graham, Warren Buffett, Phil Fisher, sort of investing, and a book by him, by Phil Fisher, Common Stock and Uncommon Profit. I think I like it pretty well because it is, I think, written almost 40 years back, but it's so relevant. It is so relevant, particularly to budding analysts. And many of those sort of students would probably take this profession. I mean, that drills the rigor of research. And research is not only related to balance sheet analysis and statistical tool, it is the extra edge which you have as an analyst compared to what the market has. Anything is all relative in that context because you're not private equity guys, you don't get access to all the information. But drilling deeper in the character of the business management, doing that sort of sucklebutt sort of inquiry, going to the ground, meeting the distributors, channel checks, etc., and then getting the grip with that grip on the business and sort of due diligence on management. I think this book by Phil Fisher, which, as I said, I think written in late 60s, is still so relevant.
Naren, what about you? If I were to request you to put one key learning out of many for our students, student viewers, and one book which you would recommend them, Naren?
I think Capital Returns, written by Edward Chancellor, is a book which I believe is very interesting. It talks about value investing, but it says that why Amazon is also a value stock. And it doesn't, I mean, he doesn't say it now, he said it years back. So I think we have to give him credit for it. So I think it's a very interesting book, if you ask me. And I've been influenced by the thought of Howard Marks. And it's a bit scary at this point of time, managing other people's money. Particularly if you are in America, it would be the worst because you have Tesla going at $600 billion. And, you know, we had these internal debates within our firm, whether we could have ever bought Tesla or held on to Tesla, or looked at many companies with the market caps that they have in the US market. And you realize that it is such a difficult, it would have been the most difficult job to be a US fund manager more than any other part of the world, because what happens is concept stocks in US are given unheard of valuations. That frankly, if the Indian stock market were to become like the US stock market, frankly, as Shankar said, very difficult for us to work. That is the biggest problem that we are going to have. That's my learning. But otherwise, I think the whole concept of cycles which are there over this period and even over the last 10 years, despite the central banks trying to dampen cycles, we have had cycles in India. And I found it very interesting that if you can guess where you are in the cycle, you've actually made very good decisions.
Right. Shankar, from the vast number of books, which is your favorite one, which you keep referring or would recommend to our student viewers?
So I have stopped reading books by, and by the way, I mean, I have nothing against, I mean, Cross and Common Profits was a very, very good book. I just find them to be not relevant anymore, at least in our current investing frameworks. But remember, as a student, read everything. Your own style will come out of, just reading the styles of literally hundreds, if not thousands of investors and books. From that, you will be able to distill your own style and strategy. Because investing is also a very personal business. You cannot become something else. You need to figure out what is your own style, but to be able to figure that out, please read all the books that are available. And it's a very cheap thing. I mean, if you invest, 5 lakh rupees, you're building a fortune worth thousands of crores. I mean, like as I mentioned, this kind of ROI is simply unavailable in any other business. So, the book, like the books by Daniel Kahneman or I forget the name of the author, but the guy who's written Halo Effect. It's a great book on, how what is great today may not be great 2 years, 3 years down the road. And I remember when in college, I had read the book In Search of Excellence, which was a great storied book. I think in 82, 83, I read the book, something like that. And within 3-4 years, half the companies, didn't exist or had become dons. So I am a big believer in not making fixed notions about what is a great company and what is a great business, because things change dramatically. Actually, in a way, Naren is right. And in India, we have it a lot easier because the same companies have existed for 30 years. Okay. But there is no great churn of leadership. If you think about it, the same steel companies, same auto companies, same FMCG companies, same banks. सब वही है. साल से नई companies का flow, if you see in India, it is minuscule, which means that the models we have used for investing can remain static. And we can be successful. That's not the case in other more rapidly changing markets. So we have it very easy in India. I can tell you that much.
No, but actually, the way startup ecosystem is seeing flow of incremental capital and some great business ideas, I think there is some activity of these new business ideas.
That's in the unlisted space. So in the
Unlisted,
listed space, there has been hardly any new inflows of major changes in the indexes, or if the last 10, 15, 20, 30, 40 years. I mean, it's all samey hai, mota, HDFC Bank 96, and then the private sector banks became 40% of the index. So India is in that sense a very, very old economy country, which only now we are seeing some tech companies getting listed like Root Mobile and all that. Hopefully that will cause Naren more challenges, and which will be a good challenge in the future when he will be forced to look at these kind of concept companies. But let's hope that India also gets a tech ecosystem where we are all forced to shed our old styles of investing, of valuation and ROC, free cash, because none of these companies will have any of that. None of them will have. So, acha rahega. I think we should encourage newer listings in India of this kind.
It will make the market much more vibrant and more interesting. Managements will start. Talking of that, Madhu, 1 lakh crore Divi's Lab crossed the other day. Were you remembering about all the meetings and your notes, previous notes? The way this company has changed, anything you can share with us? You remember talking to that management when it was a very small company? Did you had thought it will become a 1 lakh crore MCAP company? Just just asking you if some of the observations
I'll answer the question which you asked to everyone else. So
sure.
From a learning perspective, Ajay, and I'll talk about Divi's. From a learning perspective, because we are talking to students, one of the biggest learning is that never think that you know enough about markets. If I can candidly admit how much percentage do I know today and how much needs to be known more, I can't put the known percentage to be more than 10. So I think for me, I still need to know 90% more about this market. So this is after 30 years I'm talking. So anyone who is starting the career can put things in that context. And I'm being candid and honest. Right. The second thing, I could never think that this pandemic is going to bring me such phenomenal learnings because I've been at home. So you asked about book. So Ajay, this is my book. This is my diary. What I do every day, I write about my own failure experiences. And when I talk to intelligent investors, I'm curious to know about their perspective, their successes, their failures, and what did they think when they invest, what went wrong. So I think it is so enormous. I feel that I'm completely rejuvenated because of the last 9 months. And I feel just like I'm 21 years old, and there's so much more to these markets and so much more to learn. So the third point we mentioned about Divi's Lab, and trust me, there is a time when you should read a book, and there is a time that you should write a book, and you should actually write it your own experiences. And I believe firmly that after 30 years, those experiences will teach us much more than any one particular book can teach. Sure. So that's talking about Divi's Lab. To be honest with you, as I said, had I known, I would be far more richer that it is going to go to 1 lakh crore. But one thing which I was always convinced in last 20 years of investing after this company got listed in 2003-04, I have never become bearish on this company. And I've been very, very vocal about it. Whoever knows me, they know. So it's been an 8-bagger in last 2 years since, the problem happened. So this has been a very, very different management, never got into any controversy, never raised debt, never raised any equity, phenomenal business, never they had to change the business. What they were talking to investor 20 years back, they are talking the same thing today. Same thing I'm telling you. I just met them before the pandemic, and they're just talking the same thing. And they're still bullish on the business from a next 10-year perspective. So to be honest with you, could I see that this company will produce disproportionate return? Yes. But would I have seen that this will go to 1 lakh crores in 15 years? No.
One last question I'll ask all of you very quickly from my side. My own learning from this pandemic has been of spending a lot of time in non-serious things also, with your family, with the friends you love to hang out with, your hobbies, because I think we Indians tend to take ourselves too seriously all the time. So my one question I'll ask all of you, starting with Shankar. Shankar, of course, shares his non-market interests also with all of us quite a lot, be it singing, exercising, food. Let's start. Shankar, how important is it, other than making money in pursuit of success, to have a balanced life and make yourself as interesting as possible?
So, I mean, Devina tells me you're the most imbalanced person in this whole world because, and you need to correct your balance now. So, the pandemic has actually worked to the contrary. It has made us more imbalanced because it has, given us more time. And when you give people from the markets more time, you know what they will do. They will do more markets. So, we have to course correct. But, I do believe. And the other thing I must leave the students with, don't read books only on investing. Okay, so investing is a very vast subject where you will need to employ disciplines of science, disciplines of history, disciplines of literature, because everything, has a role to play in shaping your investment thinking. So don't just go and buy, 5-10 books of great investment and think you know it. When I look at my library, there are books, by Enzo Ferrari on how he built Ferrari, or there are books by, Alfred P. Sloan, on General Motors. I mean, all those things shape your thinking of businesses over decades. So just don't become only investment. So in this pandemic, I have gone back and reread a lot of those books also, just to be, refreshing your thinking.
Neelesh, what is the one thing non-market which you do to, keep your mind at ease and fresh and light?
Yeah, so it's just normal. Catching up on movies maybe multiple times. And everyone tried in their role in the kitchen, so I also did. And also on the probably, it's been very different experience when you're working with the team and analyst team and fund manager. All of us, while there are formal formats of meeting, I found that one is, of course, it has made the overall productivity. On the not impacted that, but on a softer aspect also, as a team, even with office colleagues, we have got much more closer. We now know much more about each other's family compared to when we were in office. So that's probably a good sort of side effect of this.
Madhu, you've been into yoga and meditation. How did you really rejuvenate your mind in the last 8-9 months staying at home mostly?
So, Ajay, to be honest with you, it was very, very important to be positive through this period. The spiritual side of mine has actually helped me a great deal that remaining focused and remaining positive in this pandemic, because it is very easy to now make a case, as most of us are making, that it was very easy decision. The market may have been easy, but we don't know what this disease would have done to you, to your near and dear one, and to society by and large. I don't think any one of us were expecting that there'll be a vaccine in 9-10 months.
Sure.
So I think remaining positive and remaining optimistic was one very important thing. The other thing, I must candidly admit that more time has meant more markets, but I am resolved that there is other areas of interest which I'm going to build. And to answer your question, definitely a balanced life is very, very important to get a holistic view of your overall life. And I intend being a more balanced person than what I have been.
Nice, nice. Shankar and Naren, what about you running such a large fund through this crisis? How did you spend time beyond markets?
No, actually, it's been quite tough. Actually, a lot of the work has actually expanded in this period. It's not contracted, contrary to what people thought, and actually, it's been longer hours than shorter hours. Actually, for many of us. So I have, I think, taken a call that I have to do something to reduce it in from January maybe, and
New
from
Year
the holiday
resolution.
season. It's,
New Year
you know,
resolution.
yeah, it has to be done because at the end of the day, it's even it was possibly I used to think it was shorter, but it isn't.
I understand it has been tough, no doubt, but it's been wonderful last 1.5 hour discussing so many interesting things with all of you. You know, I tell my colleagues in office also that it's such a privilege to be in this place. As Madhu was saying, you get to learn so much, you love your job, and then, of course, at the end of the month, you get paid for it. So I would like to thank Professor Punjabi for organizing this and making me a part of it with that at KJ Somaiya. Great, having great learning. Risha, I will hand it over to you with this.
Thank you, Ajay sir. The discussion was very enriching, and witnessing this has helped us broaden our perspective towards various asset classes in financial sector. Some few key takeaways from this session were the upcoming India's opportunities and central bank's role in the new era. Liquidity infused in the markets are making stocks skyrocket. It's very important to understand all the jigsaw puzzle in order to identify best sectors in every business cycle. Focus should be on picking value creating businesses at right valuations and holding them and tracking them. Self learning is very important as investing and learning go hand in hand. And finally, as Madhusudan sir said, our own experiences are the most important learnings one can get, be it in the stock market or the personal growth. Thank you so much, our distinguished panelists, for sharing their insights with all of us. I'm sure this knowledge will be very useful to each one of us. We now request Professor Hitesh Punjabi sir to propose the vote of thanks.
Good afternoon, everyone. I consider it a great privilege to propose vote of thanks to the eminent panelists who are there. It was just a pleasure hearing from all of you, and I still remember the days when I had serviced as a sell-side analyst to all of you, and as a fund manager. And every time I used to visit you, and I used to get grilled left, right, and center on my assumptions. I still remember those days. But anyways, as sir, as Madhu sir is a special alumni for us and who always walks through extra mile for doing anything for the institute. So it's a pleasure, and I hope you will keep continuing coming back to the institute and enlightening our students with your knowledge and experience. And I will be looking forward to a book from you, sir, going forward based on your experience. I would also like to thank Shankar sir, who is always, and whenever I send a mail across, sir replies immediately and always interested in sharing the knowledge with all the students. It's a great pleasure, sir, and an honor to have you with us. Thank you, sir. Uh, I would also like to thank Naren, sir, whom I have been interacting since quite some time. And Sir also is a expert in various fields. We are seen across as for a cycles, best stock picker across the best fund manager. I can tell you, students, you have heard all of them, and I can bet that you can trust all of these fund managers, and you can go and invest in their schemes. Please go and invest in their schemes. You can trust all these fund managers. They are transparent enough and you can believe on them. You have seen in this panel discussion. I would also like to thank Neelesh sir. Thank you, sir, for taking a time out of a busy schedule and making it for this event and giving us nice ideas how to evaluate the management, which is a key important point which you highlighted to focus on from the investment perspective. So after all, investments is all about what I could figure out is a own skill set which one has to master it over a period of time after spending a lot of years learning and try to reduce your errors over a period of time. Accept your mistake and improvise over those errors. That's the key thing what we have learned, which every panelist has highlighted during this panel discussion. Last but not the least, I would also like to thank our moderator, Ajay sir. He has done excellent comparing, and we have enjoyed your session with the way you took it forward. I thank you for the same. Thank you, sir. Thank you. Good day,
Thank
sir.
you.
Have a nice weekend.
All
Thank
right,
you so
bye-bye.
much. Thank you so
Bye,
much.
bye, everybody.
All the very best. Thank you so
Thank
much.
you.
Welcome to our next segment. We are happy to have an audience in large numbers today with us. And we do understand it's lunchtime and usually a time when we're a little drowsy. But fasten your seatbelts. The upcoming segments are equally interesting and exciting. So without further delay, we welcome everybody to the guest speaker session. It gives us immense pleasure to introduce our eminent guest speakers for today, Mr. Saurabh Mukherjea and Mr. Anupam Gupta. If, if compounding is the first step towards long-term wealth creation, Mr. Saurabh Mukherjea stands out on the Dalal Street as a fund manager who has been at it constantly to master the art and science behind it. Mr. Saurabh Mukherjea, CFA and an alumnus of London School of Economics, is the founder of Marcellus Investment Managers and an author of 4 bestseller books: Gurus of Chaos, The Unusual Billionaires, The Coffee Can Investing, The Low Risk Route to Stupendous Wealth, and the Victory Project 6 Steps to Peak Potential. For 3 consecutive years in 2014, 2015, and 2016, Mr. Saurabh Mukherjea was rated as a leading equity strategist in India by Asia Money.
Along with Mr. Mukherjea, we have another guest, Mr. Anupam Gupta. He's a chartered accountant and an investment research consultant. Over the past 20 years, Mr. Anupam has worked with some of India's leading equity brokerages and has written reports on diverse topics. Mr. Anupam also hosts the award-winning personal finance podcast, Paisa Vaisa, which in 2019 was voted the best business podcast in the Asia Podcast Awards. So, please join us in welcoming our guest speakers, Mr. Mukherjea and Mr. Gupta.
Hi there, can you hear us?
Yes, sir.
Thank you. Are you there?
I'm there.
Go for it.
Okay, so can we start?
Yes, sir.
I will take so I'll start the first half of this presentation and Saurabh will come in for the second half. I hope that everybody can see the slide out here.
Yes, sir, we can.
Okay, so we are starting. So first of all, a big thank you to Hitesh Punjabi, to all of you at Somaiya for having us here. We're going to present you today the results of 2 years of research on the drivers of outsized professional success in highly competitive industries and professions. As I said, Saurabh, I'll be starting the first half. Saurabh will join in for the second. So let's begin this. This is something that all of us know. India's GDP has tripled in the past 20 years, and even on a per capita basis, we've gone up to around $2,000 from around $600 in the past 20 years. And this is an economic feat that hasn't been seen in the history of this country. So we've grown faster than any democracy has ever grown in the history of this planet. In fact, India has grown faster over the past 20 years than any large country has ever grown, with the sole exception of China. And yet all of this prosperity hasn't produced any happiness. Nearly half the marriages in our large cities are breaking down. Job security is a source of mental stress for a large part of the workforce. The statistics that you see in front of you are all part of various studies done, and some of us would know. Like for example, NPAs in the banking system are up 4 times in the last 10 years. Till recently, equity mutual funds weren't even giving 5% returns in the past 5 years. So no wonder then that Dr. Sharmila Banwat, Mumbai-based psychologist that we spoke to, says that she sees when people, her clients, who cannot figure out how to strike a work-life balance. They know it conceptually, but they don't know how to implement it. So what exactly is the problem? So what we believe is at the core of the human mind's inability to find happiness, even after a lot of hard work and success, is the wiring of the human mind. So if you look at the picture below on the extreme right,
Some of you, it's a very famous picture, and some of you will probably see a young woman, some of you will see an old woman. I personally saw an old woman first when I saw this picture, and then obviously, eventually I could figure that there's also a young woman depending on how you see it. So psychologists and cognitive scientists like Nick Chater, Stephen Sloman, Philip Fernbach are telling us that we suffer from three illusions. The first is a knowledge illusion, that we think that we know everything in this world and we can explain such complex things like how Reliance works or how an iPhone works, whereas in reality, we probably wouldn't even know how a zipper works or a toilet flush works or how a cycle works. The second illusion is that we think we can multitask when in fact we can't. One very common example that that you would see is that using the mobile phone while driving, even if it is a dashboard in your car, there's enough research to show that even doing that puts you at a certain amount of risk. And the third is a visual illusion, the fact that we think that we are reading an entire page of a book or even of the slide, whereas at best eye tracking software has shown that our eyes can focus only at 12 to 14 letters at one time. And as if all this weren't enough, right? These three illusions. Our memories are also fallible. We think that we can recall our past memories with clarity. There's a good chance that you're just believing in a story and putting all the other parts together. So one great example to bring this point across is something that Nick Chater had done, where he had asked people in a room to visualize a tiger in their heads, okay, without seeing one, obviously, and then asked them to to think about how the tiger's stripes flow across the body. How are the stripes on the tail, on the body, on the head, on the legs? And most of us think that we would know how a tiger is. We probably say that it goes from right to left or it goes from up to down. Whereas, as you can see in the middle of the slide, the tiger's stripes are actually, they flow differently on different parts of the body. And as expected, a lot of people got this wrong. So, the thing is that if you're wondering how we've survived so far, the brain makes shortcuts or heuristics, as we know. If any of you have read Daniel Kahneman's book, Thinking Fast and Slow, he talks about this exactly. So these shortcuts help us survive through life. But how do we actually thrive? How do we push forward to make our lives more meaningful, both on the personal front and on the professional front? Our thesis is what we call the simplicity paradigm. It's a three-tiered structure framework that starts from first principles and actually goes all the way up to actual results. So the first tier consists of three core beliefs, which is specialize, simplify, spiritualize. On top of this, you add specific behavior, which is declutter, creativity and memory, and collaboration. And as you implement this 6-step process, you'll see a massive transformation. And the top tier that you see is the result. In our experience, both in investing and in business, the most effective exponents, the most effective practitioners have adopted variants of the simplicity paradigm that we will now outline to you in the next few minutes. So let's start at the bottom. The first tier, specialization. So we can see that specialization works. From Virat Kohli in cricket, aside from what happened today, to Charlie Munger in investing, to Steve Jobs in business, Shah Rukh Khan, Ashishkumar in movies. One of the big trends in the last decade is the rise of the specialist. So the idea of specialization was actually created 300 years ago by Adam Smith, but the recent focus on specialization can be traced to Malcolm Gladwell's book Outliers, which talks about 10,000 hours of practice to master your talent early in your career. Probably, as some of you in the audience would be, and you would have seen that the people who came before us in the prior session are all masters of their trade. So the question that gets asked to us very often is, what do you specialize in? Where do you start? And the answer to that is a very simple framework given in a book called Mastery by an American author called Robert Greene. And he says that you start with something that you love, something that innately appeals to you. So find a subject or area that intrigues you, that appeals to you. Second is, once you find that area, find a guru to mentor you. The guru is someone who's mastered this specific area and can guide you and can give you shortcuts and share his knowledge. And finally, once you've learned all of this, you go into the creative active mode. You combine the rational part of your brain with the emotional part, and that eventually builds mastery. So what are the examples that you can see in this? So Charlie Munger of Berkshire Hathaway is one example that comes to mind, especially since we're talking about the investing context. But closer home, there is, of course, Ramdev Agrawal of Motilal Oswal, and he's part of our book, The Victory Project. And he was very clear about two things very early in his life. The first was that he wanted to become wealthy. This is someone who's come from very poor, very humble background. And the second was that he wanted to become wealthy by investing. So how did he do this? How did he achieve mastery? He developed skills very early in his career. So when he came to Bombay, this is the 80s and the 90s, there was no mobile phone, there was no laptop. He had a very clear way of thinking. So when he would go, for example, to any restaurant or any place to have a coffee or a meal or a breakfast dinner, he would mentally map out the entire floor space that he could see in front of him, the number of tables, the number of chairs, the number of people coming, the time that they spent, the average cost of a meal, the average price, of the rental, essentially an entire P&L of the business in his head. And then he would go and talk with the business, with the person sitting at the desk to figure how much of it was right and what suggestions he could give. Then he went on to find a great mentor in the form of Sanjay Bhattacharya in pursuit of that goal. And from then, he developed skills that enabled him to bet very large sums of money on very successful businesses. And now, as we know, Motilal Oswal is one of the leading financial services firms in our country. So that's specialization. Then we move to simplification. Now, we are all consumers of simplicity. If you look at what, what you consume or what you invest in, all of us are probably, consumers of this kind of simplicity. So take the iPhone, for example. It's best known for how it made mobile telephony very simple. It costs less than 500 and retails for more than 1,000. Or say a McDonald's burger that made fast food ubiquitous all over the world, or index funds that seeks to simplify investing to a very large degree that Vanguard had launched in the financial world, or the concept of an SIP that you invest identical amounts of money month after month and without much thinking to achieve your financial goals. So these are all powerful products of prosaic, powerful examples of prosaic products that deliver simplicity in our lives. So delivering simplicity sounds easy, and these products have actually changed the world, but creating them is not easy at all. And the way it's done is done at two levels. One is simplification through process, and second is simplicity through principles. So let's take simplification through process, through habit, through routines. And we look at Krishna Devaraya, who was a dominant ruler of the Deccan, and by far the mightiest ruler the Deccan has seen some 500 years ago. And his routine was legendary, as Manu Pillai has captured in his book. Every morning, he would wake up early. He would drink a 3/4 pint of sesame oil, after which he anoints himself all over with the same oil. He would then work out with great weights, exercise with a sword, and wrestle with one of his wrestlers till he sweats out the entire oil. And then he would go horse riding before daybreak. And finally, when it was time to appear in court, he would wear a tunic, a brocade cap, and seat himself on the diamond throne. Now, obviously, you and I might not be able to be an Indian Maharaj, but extensive research shows that creating a routine is one of the most powerful keys to living a successful life. So that's the first one, simplicity through habit, through process. The second one is a slightly advanced level of simplicity. It is simplicity through principles, which is a more, it's more advanced than the first one. So if you look at how Saurabh and his colleagues at Marcellus manage money, it's an approach called the consistent compounders, where they refuse to invest in companies that don't have revenue growth of 10% and ROE of 15% year after year, not on a CAGR basis, but year after year. Marcellus only focuses on those companies that actually deliver these results as a central framework to maintaining their discipline. So whether it's the iPhone or the McDonald's burger or the SIP or the index fund, once all these products hit the market with success, all of us think that it was very easy to make. But simplification through principles is the ultimate sophistication. So that's it from my side. For the rest of the presentation, I now hand it over to Saurabh.
Thank you very much, Anupam, and thanks to Mr. Punjabi and to KJ Somaiya for inviting Anupam and me to such an august gathering. I saw the heavyweight investors who were in the roundtable discussion before. It's a privilege to be part of such an occasion. So let me finish off, folks. Let me finish off on the foundational layer of the simplicity paradigm. So Anupam focused on specialize and simplify. I'll focus on spirituality. It's easy to be cynical about spirituality, and I have to confess, I too was very cynical on this subject until I became an investor a few years ago. And that's when I realized that there are no future facts. There are no future facts that will help my colleagues at Marcellus or help me look after the monies of thousands of people. Spirituality in that context becomes a bridge between our abilities and applying that ability to the world around us. So let's just be clearer about this. I don't know for certain what will happen on Monday when the market opens, right? But rather than staying up through the weekend and fretting about my lack of knowledge of the future, I need to control my mind, my emotions, and stay as rational as possible. The better I can get at this, I'll be able to deal with greed and fear, far better than I currently do, right? Now, the most famous investor who has spoken about this point very clearly is Ray Dalio. So he says, and I quote from his book, Principles, he says, the most valuable habit I've acquired is using pain to trigger quality reflections. If you can acquire this habit, if you can acquire this habit, you'll learn what causes you pain and what you can do about it. And I'll stress this again. If you can acquire this habit of triggering quality reflections, you will learn what causes you pain and what you can do about it. And it'll have an enormous impact on your effectiveness. Another American fund manager who's written beautifully on this subject of the link between spirituality and success in investment management is a man called Jason Boss. So Jason came to the CFA Society conference 4 years ago to talk about his book, The Intuitive Investor. I'd read the book, so I met him there, and over the course of writing the Victory Project, Anupam and I Skyped with him a couple of times to interview him as to how did he hit upon this link between spirituality and success in investment. So Jason said that, look, spirituality helps you make better investment decisions. Why is that? Because meditation not only helps in relaxation, it helps you improve focus. It helps you understand that your family, your friends, and your colleagues' happiness is far more important than your own happiness. In simple terms, he says, meditation heals your mind and lets you perform better for longer. I'll now quote from Jason's superb book, The Intuitive Investor. Meditation techniques are polishing techniques. Meditation practices are polishing techniques that help you be the best. You need to find tools and techniques that exalt your consciousness. Once you discover what makes your talents unique, and that's only found through spirituality, then all of a sudden magic happens, right? So it's a fascinating subject. We could go just do an entire lecture on this, but I think that for today I'll just stop there. So that's the foundational layer, the basic layer of the simplicity paradigm. For all of you aspiring to be like the legendary fund managers who spoke a few minutes back, the place where you start is specialize, simplify, spiritualize, right? Now let's move to the more advanced level skills, right? The more advanced level skills, we start by clutter reduction. Why are we starting with clutter reduction? Even if you or I meditate every day, if you can't manage your tasks, right? If you can't manage your tasks or your projects, your mind will go into cognitive overload. Your system will go back into stress due to cognitive overload, right? So you've got to make a conscious attempt to focus on what is important for you, really, really important for you. But the question then you'll say is, well, how do I know what's important for me? So whilst writing this book, we met another famous investor, Professor Sanjay Bakshi, the managing partner of Quest Capital in New Delhi. And he spent 2.5 hours on a Saturday morning in Lodi Hotel in Delhi having breakfast with us. So Professor Bakshi is a big believer in this idea of intense focus, right? And he cuts off all distractions to spend high quality time on a single idea. He showed us his phone, and we saw the blank home screen. There was nothing on it, no apps, no notifications. Throughout our 2.5 hour meeting, the phone did not ring or beep or light up even once. And in those couple of hours, I think I got some of the deepest insights into fierce focus that I've received in my career. Chapter 3 of the Victory Project contains these insights. Cal Newport has written 2 outstanding books on this subject, right? On the subject of deep focus. And studying the lives of business legends in India, like Harsh Mariwala, has shown us that there is a step-by-step guide to reducing mental clutter, right? So how do we reduce mental clutter? You begin by being very clear about your goals. Now, again, it sounds simple, but it's not easy, right? It's not easy to be clear about your goals. An example of a clear goal is this one that a fellow fund manager in California gave me last year. He told me, I focus on very few things: my family, my investors, and my closest colleagues. I deprioritize everything else, right? Once you have clarity of this sort on your goals, you move to building prioritized checklists that help you with execution. How do you build prioritized checklists? The most famous book on the subject is by Atul Gawande, The Checklist Manifesto, right? So you get your goals sorted out, you build checklists to execute. Now, why are we doing all this? Why are we so focused on the subject of reduce clutter, focus, create checklists? Because there's a lot of research which shows that memory plays a key role in creativity. And the less cluttered your mind is, the more creative your mind will be, right? This is super important. The less clutter you have in your head, right, the more creative you will be. And creativity, you'll see, we'll discover in a minute, is the source of most wealth and prosperity in our world, right? There's something called the Ebbinghaus forgetting curve, and it captures the link between clutter and memory. Clutter, memory, creativity. It's a very tight link, and we'll come back to this in a minute. So let's go to the next level of the simplicity paradigm. Let's focus on creativity. In a highly competitive free market economy, right? And we're going to be honest about it. All of us live in a highly competitive free market economy now. The socialism era is long gone. In a highly competitive free market economy, even if your or my ideas are only marginally better than that of our peers, right? We'll be in high demand. Original thought, therefore, becomes the key driver of wealth and success in our world, right? Original thought, not which family you come from, which caste you belong to, what language you speak. The main driver of success in a free market economy is original thought. Question then is, well, how do you or I produce original thought, right? And there's a lot of research from psychologists that we can refer back to. So people like Adam Grant, Doris Wallace, Howard Gruber, they've shown over the last 30 years that there are 5 drivers of original thought which are very common the world over, right? The first of these is reading widely. So as Charlie Munger says, right, famously says, he has never met a smart person who does not read widely. Every expert Anupam and I interviewed for this book turned out to be a voracious reader. For my part, I ask almost everybody I meet what their favorite books are. I then create a long, big list on my phone, and every Saturday morning, I sit in this chair, have a cup of coffee next to me, and buy my books for the week. And I have to confess, I spend almost all my free time reading, right? Second driver of creativity, explore the world, travel extensively, meet people from a variety of religions, from variety of cultures, go through a range of experiences. The more diverse the experiences, the better. Most of what I learned before I became a professional investor came from doing odd jobs as a teenager. Backpacking holidays, friendships formed in the betting shops and the bank branches where I worked through my teens and my early 20s, right? Like third driver of creativity, enhance your memory. People who have developed their memories to a very high level have learned how to focus their attention on essential information, right? There are specific memory enhancing techniques which are worth learning. You can find them easily on the internet. Anupam and I have given you some of these memory enhancing techniques in the book. Work hard, produce lots of ideas, right? It is no surprise that all the creative giants have a very high output rate, right? In the book, we have described one of my heroes, Oscar-winning film director Satyajit Ray. Satyajit Ray directed 36 movies in a 35-year career. Whilst we were doing one of these sessions for the CFA Institute, we learned that Woody Allen, the famous American director, Woody Allen, he too has directed 35 odd movies in 35 years. 22 of Woody Allen's movies have been nominated for Oscars, right? That's some phenomenal success rate, high output rate. And the final driver of creativity, make friends, jam with other creatives, find allies, find people who can give you emotional support, intellectual support, and practical help. Now, it's always good to sort of have a role model in mind, right? When you're trying to when you're trying to drive towards a virtuous ideal, it's good to have a role model. And we see in India all of these qualities in Sanjeev Bikhchandani, right? The man who defied convention at almost every step to create Naukri.com. Naukri.com sits inside, as I'm sure you know, Naukri.com sits inside a company called InfoEdge, which is on the cusp of entering the Nifty. Sanjeev created this homegrown case of a brilliant Indian entrepreneur, now a venture capitalist. Iconoclastic guy, does not care about conventional wisdom, sits and builds multiple companies who go on to become worth several billions of dollars. I think one of these companies, InfoEdge, has an investment in Zomato, did another round yesterday at a valuation approaching $4 billion, right? So we've described Sanjeev's career in the book, distinct from whatever we say. It's worth looking up this guy's career. Remarkable man. Let's come to the final step of the simplicity paradigm, the final facet of the simplicity paradigm, which is collaboration. No matter how creative you are, if you want to change the world with your ideas, you need to learn how to influence people and win their support and their collaboration in favor of your cause. What you'll see that the greatest teams are teams of rivals, teams of diverse sets of people who might not always agree with each other, but who come together to pursue a common goal, right? This is really, really important, right? The Indian education system, unfortunately, doesn't teach us this. Indian education system says, "Padhai karo, number lao, aage badho zindagi mein." That unfortunately doesn't work. What you need, we need to do is work in teams of people with diverse talents. Now, the most famous examples of this are Abraham Lincoln and the Civil War cabinet, which sort of retrieved America from the ashes of the Civil War. Back home in India, Mahatma Gandhi and the first cabinet created after independence. What Gandhiji did was he brought people like Sardar Patel and Baba Saheb Ambedkar together. These are fierce political rivals. He united them in the common cause of building the constitution which governs our lives. Even if you come to the world of investments, right, where I exist, you'll see that the collaborative spirit, this collaboration of very diverse talents, drives almost all the great investment partnerships of our era. Whether it is Warren Buffett and Charlie Munger, Motilal Oswal ji, Ramdev Agarwal ji, in America again, George Soros, Stanley Druckenmiller, right? Why is it that these partnerships thrive? Because if you take two very different people and they agree to work together, you necessarily get whole being greater than the sum of the parts, right? There are several examples of these great partnerships, these great collaborative endeavors in the book. The one I feel most proud about as an Indian is Verghese Kurian and Amul, right? Verghese Kurian ji built Amul from a company that was nothing in 1947 to a company which is 3 times the size of Nestle India today. Amul is collaboration on an epic scale, right? Just think about it. I think Nestle India market cap is what, $22 billion. If Amul were listed, how valuable it would be. It would easily be a nifty company, right? Amul, as many of you know, is actually the Gujarat Cooperative Milk Marketing Federation, right? They procure on a daily basis 2.3 crore liters of milk every day from 19,000 village milk cooperatives. And this includes at the base 36 lakh milk producing members every day, right? Epic example of collaboration for a not-for-profit cause, right? We can discuss collaboration for a long time. I'll give you one more very striking example, the Marwadi community in India. Unlike these other collaborative ventures, the Marwadi community does not have a leader who says, sab log collaborate karo. The Marwadi community is a very interesting example of 8 million people collaborating with no leader and having outsized impact, right? As many of you know, their impact on the commercial and business landscape of India is far beyond their very small population. And why is that possible? Because of a very tightly collaborative ethos, right? So we'll discuss this later on if you have time. But this is, I think, for me, the most fascinating aspect of this book that Anupam and I have had the fortune of writing. The fact that it's not the individual who drives success. It's the team, it's the collaborative endeavor which drives outside success. So what are the investment implications? What did I learn as an investor from this journey? Simple investment ideas deliver remarkable results if implemented by a motivated and committed group of individuals, right? This collaborative aspect of investing, I think, deserves far more focus than it gets, right? I'll tell you some of the key things I've learned over the past 5 years in the subject of collaboration in investing. In the Victory Project, I've narrated my personal experiences where meeting other thinkers for dinner or drinks gave me the kernel of the ideas which now define Marcellus Investment Managers. So, for example, I first learned about Rob Kirby's 30-year-old paper on coffee can investing over dinner with my fund manager friend, Sanjay Bhattacharya, who's also Ramdev Agarwal ji's mentor. Sanjay told me to read the paper. I read Kirby's paper. It changed my life. The idea behind Marcellus's Little Champs portfolio came from reading a German management consultant called Hermann Simon. His book, Hidden Champions of the 21st Century, gave us the idea for Little Champs. 4 years ago, John Kay, one of my gurus in the UK, asked me to read the book, right? If you look further, right, if you look further on this power of these simple ideas, look at Vanguard, right? Vanguard is a very simple idea. John Bogle came up with the idea of index funds back in '76. Vanguard now manages $6 trillion. I read in an SEC filing last year that Vanguard's current staff alone, and remember this is the third generation of Vanguard staff. Vanguard's current staff alone own $120 million of Vanguard units, right? And this aspect, right, collaborate, learn from others, come up with simple ideas, implement them with a cohesive team of committed individuals, and go on to create, go on to change the world. We have given you several examples of this in the book. Let me now bring the presentation to an end. That over the past decade, we have tried to understand the drivers of greatness in India. We began with corporate greatness in the Unusual Billionaires. We profiled in the Unusual Billionaires a unique set of companies who have delivered outstanding financial performance year after year, right? Then we took these drivers of great financial performance and we translated these into guardrails for building a high quality portfolio. We did this in the book Coffee Can Investing, where we showed that a very simply constructed portfolio can unlock significant financial gains, right? And we now finished this trilogy. We finished this trilogy with an overarching philosophy to live great lives. In spite of everything that's happened over the last 6-7 months in our country, right? In spite of all the tragedy that has folded around us and from the early part of this year, we believe we can live fulfilling lives by following the simplicity paradigm. So thank you very much for inviting us today and for giving us your time and attention. We'll put up a slide which summarizes what we've learned, and I'll hand it back to the hosts for them to tell us what they want us to do next.
Thank you very much, sir, for giving us a glimpse of your book and sharing so much knowledge, not just about, it's just not about technicalities, but also on how important it is to be a rational person. We're in a time where everything is getting so competitive, be it businesses, be it work environments within a firm. So where we struggle daily with unattainable goals, multitasking, knowledge illusions, and all of this, after considering all of this, I think your book will be a wonderful read for everyone. So I think this book would definitely help us declutter our thoughts. Sir, actually, yeah.
Go on.
Yeah. So actually, we have a few questions from the audience for you regarding investments in general, if you may like to take them up.
Yeah, sure, go for it. We'll try our best. But I don't want to get into what stocks and Nifty and all of that stuff. This is Saturday, so I don't want to discuss the market or stocks today.
So I'll pose the question. You may answer if you may like.
Okay, go on. Why don't you just read it out and we'll try our best.
Sure. So we have a question from Mr. Pramit, an alumni. Which are the lucrative sectors that will flourish for the next 10 years?
No, I don't want to do that. This is Saturday afternoon. Yeah. Why get into sectors and stocks? We do enough of that Monday to Friday. There's, I come on TV. You can watch me on TV. There are any number of broker reports. Let's use the fact that it's a holiday. Let's relax. Let's let our minds blossom. As I've said, right, as Anupam and I have explained in the book, you don't make money by knowing which sectors will do well, what will GDP growth be next year, which stock should I buy. That doesn't make you money. What is the core driver of success? It is original ideas. It's original thought, right? So let's just use the privilege of this time that we get on Saturday, Sunday to let our brains go away from the day-to-day stuff about stocks and Sensex and sectors, and read widely, because that's where real money is made. Real money is not made by my telling ye 3 sector achhe karenge and everybody goes and buys those stocks. Nobody's going to make money like that.
That's very true, sir. So I think a couple of questions you received are all related to markets and investments.
Don't want to do that.
Yeah. So
everybody wants to discuss what books to read, what books they want to tell us, what books they have read. Happy to do that.
So if you could just talk a little about what books would you recommend other than these books in general.
Sure. Anupam, do you want to go first on subject of interesting books?
Yeah, so the subject of interesting books, Saurabh. So my interesting books are anything that has to do with Indian corporate history, Indian entrepreneurship, because there are not so many of them. I mean, the stuff that we get recommended usually is all of the US, Europe, which is not bad to say. But I think that anything that is engrossing that has to do with Indian corporate history. So, for example, in this book, we've taken so many books. Saurabh just mentioned the book about Marwadis by Thomas Tinberg. Then there is the TCS story by Mr. Ramodorai. There is the two books by Hamish McDonald on Reliance. There is a book by Captain Gopinath on aviation. There is a book by Dr. Kuri on Amul. So any of the books that have to do with Indian corporate history and about Indian entrepreneurship are of immense interest to me, especially the well-written ones. Saurabh.
So just to cite a couple more. So Varghese Kurian's biography, I Too Had a Dream, outstanding book. Example, as I said, of a man who builds a great institution, products. I'm sure all of us on the Zoom call use Amul's products every day to understand how that cooperative institution was built and how it's changed the lives of millions of people. It's just incredibly inspiring, and there's a lot to learn from how he went about building Gujarat Cooperative Milk Marketing Federation. A book that's proved very useful for us, both for writing the Victory Project and for living more interesting, more fulfilling lives, is a book called Daily Rituals by an American author called Mason Curry. So what this gentleman's done is, in a very slim book, Mason Curry has laid out the daily kind of schedules, routines of say 150 famous people, authors, journalists, architects, scientists, musicians, and he's helped us see how they live. And what's very interesting is there's sort of three very common things that seem to be common across individuals are incredibly successful. One is they follow a tightly structured routine. So even sort of bohemian people, right, artists and painters, they also seem to follow a very structured routine. Two, they don't waste time. They don't sort of hang around, wasting their time. Even if they have downtime, the downtime is generally spent relaxing rather than sort of watching movies on OTT platforms. And third is this non-stop reading, the Charlie Munger point, right? He's never met a smart person who does not read non-stop. So Daily Rituals, slim book, very interesting book on how to live a better life. Varghese Kurianji's biography. And for I presume since many of your students, I wish Range from David Epstein had been published when I was a student, but it was published last year. I think super book by Epstein on how you can build specialist skills in one profession, say in my case in fund management, but you also need to have a wide range of interests. If I just say I'm a fund manager, but I'm not interested in music, the arts, in literature, in psychology, in history, then I'm not going to be very good as a fund manager. So Epstein gave us what we have called in the book the T-shaped paradigm, right? So your specialism is the vertical part of the T, and your wide range of interest is the horizontal part. And he explains that whether you're the captain of the Indian cricket team, you're a dancer, you're a politician, you're a fund manager, most of us need to follow the T-shaped paradigm to have outsized success. Back to our host, Krisha.
So actually someone's asking that, probably if they're not an avid reader, so are these books for people who are avid readers or probably for starters as well?
So anybody can read Range. Range is not a finance book. Range is a book on how to build skill sets. Daily Rituals is a book on how to live a better life. These are not finance books. In fact, if you really want to, if the implicit point of the question is to say how do I become a better investor, then read as many non-finance books as possible. I mean, figuring out financial statements, valuation is not that hard. I mean, all of you, I'm sure, are getting a very good education at KJ Somaiya. It's not very hard in the modern day and age, given the amount of resources we have, to figure out how to read financial statements and how to do valuation. So what is it that distinguishes great investors such as, say, Naren or such as Warren Buffett from the rest of us? What distinguishes them is their ability to read hundreds of things which are beyond finance. That's where the ideas come from, right? So it's just as likely that any of us on this Zoom call today will make more money reading about what Varghese Kurian did in Amul, which has nothing to do with the stock market, as we will by reading some broker report. So the more widely you read, and the less finance, the less you read about PE multiples and EPS and so on, the more likely you'll succeed as an investor. And these books are easily available now. Obviously, anybody can go online and buy them for a few ₹100. And this being India, for those who don't want to buy books, then there's obviously the pirated copies which are available at the traffic lights of Bombay. You can also have recourse to that. But please read, because as Charlie Munger has said and Anupama and I discovered, it's very difficult to find successful people who don't read non-stop, because your brain sort of rots if you don't read non-stop.
And especially, so I'm not quite sure, Krisha, what do you mean when you say if I'm not an avid reader?
Probably someone who's not too much into reading or does not enjoy reading much, but definitely would want to, inculcate that habit and take the learnings from reading.
So I think that if you read a book, we've made we've spent a lot of time in making the point that you should read. So it's any day is a good day to start reading, and I hope that you become avid readers, because that's actually it's anyway. I mean, Saurabh has already said.
There's a great book idea here. How you can write a book, How to Succeed Without Reading. That might be a book. That actually, who will read the book which says How to Succeed Without Reading?
I think that book has one blank page, Saurabh. That's what I can think of.
No, so folks, jokes apart, if you're not reading, start reading. If you are reading, read more. But it's very difficult to figure out how someone can succeed in any line of work, not just investing. How can you succeed in any line of work without reading non-stop?
And if you think that reading your WhatsApp is reading, then I think our book, if you buy a book, you might figure out an alternate point of view.
Yeah, sure. Thank you so much. Okay, one last question was, could you please could you please share your learnings from your mentors which shaped your investing style, or in general, any learnings throughout your career?
So in 2014, I wrote a book, Gurus of Chaos. That was my Guru Dakshina to the people who taught me about India. So from Naren, Naren is in that book. I learned from Naren the need to read non-stop. So if you guys see how much he reads, a lot of people know that Warren Buffett and Charlie Munger read 500 pages every day. I don't think Naren reads any less, right? And I learned from him this sort of the need to be almost addictive about reading, right? And the need to not just read classics like Howard Marks's books, Michael Mabusson, James Vontier, but also go beyond finance. In Gurus of Chaos, I also played a tribute to B.N. Manjunath, one of the first mutual fund managers in India. And he sort of inculcated in me the value that there are lots of corrupt companies in India. You should just steer clear of them. Doesn't matter how cheap they are, because a lot of people in our countries believe that even corrupt companies can be bought at sasta valuation. And B.N. Manjunath ji taught me that that's not true. These people are beyond incorrigible, and just stay away from them. In that book, I also paid tribute to K.N. Sivasubramaniam ji, the erstwhile legend at Franklin Templeton. He taught me the importance of just staying calm, play the long game, relax. The market's not going to run away from you. Nothing, incredibly powerful will happen in the next 48 hours. Play the long game. So stay rational. Don't get caught up in the swirl of emotions. Beyond the gurus that I paid tribute to, Gurus of Chaos, whilst writing Unusual Billionaires in 2016, and then whilst writing this book, Victory Project, we learned a lot from, say, Harsh Mariwala ji about how a great promoter thinks about capital allocation. How does a great promoter build a great institution? It's not just about making money. How do you build a enduring institution which changes the country, which serves the needs of millions of people, which generates billions of dollars of wealth, right? It's not an easy thing to do. And there's probably half a dozen people in our country who can teach us how to do it. I think Harsh Mariwala is one of them. There's probably, if you had to count on the fingers on one, Aditya Puri ji, Uday Kotak Saab, Sanjeev Bikhchandani ji, right? So we paid our tribute to these people. And I think that's how a good life can be led. You choose your role models carefully. And then you spend time understanding their journey. If it's available through their books and biographies, brilliant. If it's not, you seek them out and you understand their journey. And then from their journey, you try to see, well, what can I do to make myself better? What can I learn from Harsh Mariwala, from Sanjeev Bikhchandani, from Apurva Purohit at Radio City? What can I learn from K.N. Sivasubramaniam, from a Sankaran Naren, which will allow me to be a a better person, a better businessman, better family, a better family man, a better colleague, etc. But none of this is possible without reading. So I was a little perplexed as to what that person meant, and I think Anupam was perplexed as well, as to, especially since we are in a seminar hosted by an institute of management. Why would you not want to read? I mean, for people like us, right, when we were growing up, it was actually not easy to afford books. So I remember I used to sell our Purana newspapers to earn enough money to buy second-hand books. And as I said, I worked through my teens to be able to afford books. But for people who can afford books and don't read, that's thoda sa unforgivable. Yeah.
And there's a wonderful anecdote, Saurabh. If you remember what Ramdev ji had told us, how he got the idea of finance. It's so fascinating. This is the 80s, where there was no, nothing digital, and there used to be. And Ramdev ji at that point of time was a very humble origin. He told us that he used to go to circulating libraries, which is a concept that is absolutely unknown to all of you. Now, a circulating library, as you can figure from the two words, circulating means you give a book and you get, you pay money, pay a deposit, you get a book, give it back, get a book, read it. And a library means there's lots to read. Ramdev ji read what he said was the most obscure type of books at that point of time. What are these books? Financial thrillers. Financial thrillers at a time when the entire world was reading Harold Robbins, Jeffrey Archer, Sidney Sheldon, which are all great. I mean, there is nothing to take away from them. But he found that nobody used to read these books, and they were available for a song. So imagine going to a library, paying some 1 rupee, getting a book, and getting the foundations of your investing career from that book. And he mentioned so many of those books, $1 Billion Swap and whatnot. And that's how he built his whole thing. That is, the joy and beauty of reading. So, I mean, I honestly am quite distressed when I hear someone saying, if I am not an avid reader. To me, the thing is, if you're not an avid reader, then what are you? Sorry about that.
Thank you so much. Anupam sir, anything you would like to share about your learnings throughout your chartered accountancy or your consultancy career?
So I think that, Saurabh has already said about reading. I think the other two things that I've learned throughout, through various ex-bosses, even from Saurabh and even from a lot of other people, the one is the first thing I think is discipline and having a routine. I think, just having this chaotic kind of lifestyle where the first thing you do when you wake up is look at a mobile phone, read the notifications, and you carry a mobile to your loo and then whatever. I think discipline is central to anything in life at any age. I mean, you just need to carry it throughout. If you don't know in advance what you're doing for the next 24 hours, and if it is not a very black and white and a rigid schedule and a discipline, I don't know of any other thing, So that is the first thing. And the second is an idea that's probably a bit contrary to discipline, which is chaos. But that should be in your head. We've dealt with this topic in depth in creativity. The fact that you have to challenge accepted notions, go against the convention, question widely held beliefs. I think we live in an era where we need to do it in general, rather than blindly accept whatever comes to us on WhatsApp or wherever it is. So I think those two things are pretty central as principles throughout your life.
Thank you so much, sir. So I'm very sure that all the management graduates and everyone present here are going to benefit from this session. And it was a great pleasure to have both of you all as guest speakers today. And I'm confident that the audience will be eager to get their hands on this book.
Thanks.
So I will now request Professor Sunil Parmar, sir, to propose the vote of thanks.
Okay. So, as Mr. Anupam and Mr. Saurabh, they were talking about, the reading habits and the books. One thing, that struck me was basically you also deal with, rural intelligence, because rural intelligence, when we say, essentially they are those concepts and they are those innovations which are born out of hardships, because as they say, necessity is the mother of innovation and invention. Okay, so and if you see the examples which the speakers they give, somewhere, the authors or the innovators have had their roots, with this particular kind of a setup. So in a way, that's a point which is very well, taken. In congratulations to both of you, sir, that for putting this across so very subtly and in a very simplified manner. And we are pretty sure that your work, especially when you talk of a trilogy, which is a specialization, you're talking of simplifying things, and you're talking of spirituality, does fall in line with the overall way things are governed in life, because you come across trilogies, you come across the duality of governance. There are so many concepts which I could relate to when you're presenting. On a lighter note, when Mr. Gupta, he showed the picture of the wife and the mother-in-law, you figure out, on a very light note, it brings out to as a principle of risk and return, especially if you're a finance person, that you run the risk of getting associated with unknown people. The return is you get companionship and another family for life. So that is where you say that no matter how you're a finance guy, you're looking at things, you're looking at numbers and all, but at the end of the day, your introductory slides, when you said that please understand that for tomorrow's world, there was a point that there are no numbers. So what you are looking at is not only just the quality, but the quantity, but also look at the quality aspect of things. And especially when you drilled home so very rightly the importance of mastery, being ably guided by the relevance of a guru, right? So very important, sir. Thank you so much for putting this across. And I guess generations after generations, it is an important reminder to students and practitioners alike. So we tend to forget these aspects in our day-to-day life, but you brought it back in your book, you brought it to the table for discussion. Thank you so much for that. Very much, we would like to appreciate your effort in bringing the concept of simplicity premium. Because you see, in a technologically driven world, people tend to focus more on making how different, and in a way you tend to go towards the complexity of things. But then at the end of the day, you very rightly put it, that if you make things simple for people, that is where it is going to give you the best premium. This is a very a concept which I would say will remain steady, which will remain unchallenged, and at the end of the day, it will keep on proving itself right across generations. So thank you so much, Mr. Gupta, for bringing those points. Mr. Saurabh spoke about spirituality, and the especially with this reference to Ray Dalio's balance between emotional and the rational. Uh, Especially very important, I would say, for people who are pursuing finance, because we tend to be emotional about when we see numbers, but then at the same time, he very then subtly puts it that declutter your mind. Do not be led so much into it that it leads to a chaos. Declutter, and then once you've decluttered, it leads to basically excellence and innovation. So it's a very unique and very nice concept, where people talk about learning curve, but you brought about the concept of the forgetting curve. So it's a game, it's a balance, and individual has to strike between a forgetting curve and versus a learning curve. And coupled with that, you also put forward the points on importance of voracious reading. Basically, it's a tinker to creativity in a person. And especially when you brought forward the point of collaboration, so very important, especially for students who are in these schools, that no matter what kind of a background you belong to, what kind of different school of thoughts you belong to, it is important. And communities after communities across geographies have proven that it is collaboration which actually brings the best to society. And I guess with that, you concluded so very well with the importance of simplicity in this trilogy, which brings back the things on track. So thank you so much. We really appreciate your time, your presence, and your valuable insights on behalf of the institute, on behalf of the committee. And I guess the students and the participants will be really enriched. They would have tremendous value and food for thought going forward. So over to you, Krisha and Sai. Thank you so
Thank you,
much.
Sunilji. Thank you very much.
Thank you. We can break for a couple of minutes till actually we're waiting for one of our guests, Ramesa and Ajay sir. We're waiting for Bharat sir. So just a couple of minutes till he joins in. Good afternoon, one and all. Welcome to the BizWiz Talks. We are pleased to have with us Mr. Ajaya Sharma, News Editor ET Now, in conversation with industry stalwarts Mr. Bharat Shah, Executive Director of ASK Group, and Mr. Ramesh Damani, member of Bombay Stock Exchange. To introduce our distinguished guests, Mr. Bharat Shah, Director Partner of ASK Group, is a qualified rank-holding chartered accountant, cost accountant, and MBA in finance with nearly 30 years of experience in the Indian capital markets with a deep interface in the Indian corporate world. He has a considerable understanding of global businesses, and stock picking is a special strength. In 2013, he authored a book titled Of Long-Term Value and Wealth Creation from Equity Investing, Observation, Ideas, and Reflections. Mr. Shah has written several articles on investment in top Indian business magazines and has been a speaker at several forums. He has featured in the investment series Wizards of Dalal Street and Classroom. He was featured by Forbes India as a member of 20 market wizards. His investment strategy, Indian Entrepreneur Fund, has been ranked #1 among Indian funds by Morningstar.
Our next guest is Mr. Ramesh Damani, a member of Bombay Stock Exchange and one of the most successful investors in India. He is a renowned market expert for his views on market movements and known for predicting multi-baggers. Mr. Ramesh Damani has over 25 years of experience in India's capital markets. A proponent of Warren Buffett's style of value investing, Mr. Ramesh Damani's views about equity are ardently followed. He completed his undergraduate at HR College and postgraduate at California State University. For the viewers who have joined now, we have Mr. Ajay Sharma back with us as the moderator for the session. He is among the top editorial team members of ET Now, having worked with Times Group for over 12 years. Regularly interacting with top global and domestic fund managers on their portfolio allocation approach and quizzing top industrialists on their business strategies is a critical part of work to spot themes in the investing environment. I would now request Mr. Ajay sir to initiate conversation on the theme investments in a new era.
Great. Thank you very much for this, Somaiya Vidya Vihar University, for arranging this, and Mr. Damani and Mr. Shah, of course. There can't be, because of the audience, comprising of students, I must first qualify that Ramesh ji and Bharat bhai both have been key contributors to the overall investment ecosystem in India. Not only, to our business channel, ET Now, but overall ecosystem. They've not only added value by returns, but also by the knowledge which they have shared. So I'm delighted to be, talking to both of them today on behalf of KJ Somaiya Institute. So it's great to be here. How much we can extract and learn from the experience is something we should watch out for the next 45 minutes. Ramesh ji, Bharat bhai, good afternoon. Thank you so much for joining us today. Ramesh, thank you. Great. So, Ramesh, let me start with you. I can say about you, you've been there and you've done that. You've seen cycles and you've seen the entire development of Indian stock market right in front of you for last 35 years. Share with us some of the learnings, when you were a student. And now that you're a veteran investor, you are teaching others. In fact, I know your second generation has started to become an investor, your son Ashok. So talk to us about a journey, your initial thoughts on that. Ramesh, you're in mute, I think. You're still on mute.
Sure. Sorry about that. And thank you so much, Ajay, again, for having me on your show and for Investrix, for Somaiya College. To answer your questions, Ajay, most things in life are serendipity. You don't know what leads to what. I think Steve Jobs said, connecting the dots. So my story in the stock market is a similar funny one. I was in America doing a job as a programmer, happy in my world. My father made a wager with me, gave me $10,000. He said, Ramesh, invest that in the stock market. If you double your money, that's yours to make. If you lose it, no questions asked. I thought it was a pretty cool decision. So I took the money and I got around 81, 82, which you recall was the Dow was over 1,000 for the first time in 30 years. First time in its life, actually. A new bull market had started in America. And yet, strangely enough, within 6 months, I'd managed to lose it all. Because I realized ultimately that I was driving, looking at the rearview mirror, not at the front mirror. I was buying the stocks that worked in the 60s and 70s, those inflation hedges of energy and oil, as opposed to the new industries and new technology that was powering up America at that time. So it was a very costly lesson to learn, but in retrospect, it was a cheap lesson. So then I, got bugged, interested in the stock market, and I came back to India in '89. I started my business there, and I've known Bharat Bhai almost since that time. So it's a privilege to share a studio with him. And we both enjoyed the journey. The index was 800 when I started. It's well above 45,000 right now. So it's been an extraordinary journey.
Great, great. Yes, of course, both of you are peers and friends, and of course have seen each other's journey. Bharat Bhai, you were a industry participant. If I'm not wrong, you were working with some of the companies which are big companies now, index components like Asian, but at that time was starting off with the Dani family at the company they had started, and then later subsequently you came to markets. Talk to us about your own journey, Bharat Bhai.
First and foremost, you talked about talking to the students. But yes. I would say in investing, one is forever a student. The day you think everything there that is there to be known, and one gets that conceited thought in one's mind, I think that is the day markets teach a very, very resounding lesson. So I think the beauty about these activities, it allows you to learn so much. It allows you to practice that learning. And when you practice and refine your craft, it further reinforces your learning. And therefore, I think investing is a virtuous journey of learning all through. Whether one is at 88, the way Buffett is, or at 96, Munger is, I think till you hang your shoes, investing, forever there is a learning. So I'm gratified that I'm into an activity which doesn't merely give, so to say, economic means, but more importantly, it is one of the most attractive areas in terms of relentless amount of understanding and appreciation you are in a position to get by simply being in that area. And that itself is a joy. In my roughly about 34 and a half years of work experience, it's initial about 3 years that I spent in areas other than investing. So last 32 years I have been into investing. And in a way, I think my beginning of the career with Asian Paints was a perfect thing, because I still admire and love that firm. The simplicity, the character, and ruggedness, relentless with which that business has been built is a testimony of what quality entrepreneurs managing a right kind of a business, which may look kind of humdrum kind of activity to an outsider, that what is so remarkable about paints business, but the way it has been executed, the way it has been managed, and the way the value has been created should be a case study by itself. So the initial period goes into these non-investment area, but I think my heart and passion right from the college days goes into the investing. So I keep picking up things, take up books, and whatever chance I could lay on things like annual reports to gain some insight, rudimentary kind of research. That is how it began. And after about initial 3 years of experience in the industry, other than the investments, that's where I jumped into the investment activity. One fine day, I said my heart is in this, and that is what I must do. It didn't look like a career at that time because markets were small and they were chaotic, no foreigners, no professional prospects, and coming from middle class or low middle class, you need resources to run your family. So there was that dilemma. But one fine day I said, let me get out of that dilemma and jump into it. And uh, I think probably that has been probably the best career decision I made. Barring my wife, most of the people felt that I had gone bonkers because I was in a good firm at a senior position, well recognized, and all that goes with it. And I just jumped into something which was completely different, and where in an era where investing or markets were regarded as gambler's den, that was not an easy decision to make. But I'm glad my wife supported, and I listened to my own heart, and that's how the journey began 32 years back.
Wow, that's a great example many of us who are in two minds or are wanting to make that you have to follow your heart. Rameshji, you've been exposed to the West, which is the mother market, as they say, or the entire capital market phenomena started from there, much ahead of Indian market got developed. When you look back now, the way you've seen last 10 years of furious bull market in US or overall development of capital market phenomena, and here in India, how does the journey look like? How have things changed now versus then? Some color if you could share.
I mean, whether you're in America or India, it's been an extraordinary journey. I mean, I think Francis Fukuyama wrote after the Berlin Wall fell, is the end of history. What he meant is that capitalism had triumphed and there was no more history to be written of struggle between communism and fascism and capitalism. Capitalism has survived. And if you look back to 1989 when the Berlin Wall fell, to the point where we are today, it has been the triumph of capitalism across the world. We are now talking in some sense of reversing those open borders, open trades that we've done, thanks to the Trumpian era that's coming out there. But the last 30, 40 years that we've been lucky to be a product of have been a triumph of capitalism. And I think that is extraordinary that the lessons America taught us or taught the world on how to compete, how to build brands, how to value brands, they are themselves getting different about it. So I think the most surprising change for me has been that the intellectual and moral leader of this movement, which clearly was the United States after World War II, they seem to have lost their nerve when a lot of other emerging markets are embracing this.
Ramesh, do you see the case building, which some of the market participants are talking about, for a prolonged emerging market outperformance versus developed markets now, with our signs or confluence of factors coming together? Because you've seen both the sides for a long time, so you can draw parallels.
It's hard to say, Ajay, but I'll tell you the good news first. The good news is that India is building a new bull market. Okay, India specifically, I think the evidence is so clear cut now. It seemed 6 months ago when Reliance was making new highs and the market was moving up, we were all saying that the market was on liquidity bubble or the market was going up without merit because industries were closing down, people were unemployed. But I think now with the vaccine in sight, the economy recovering, tax collections at 19 highs, they've already, GST, direct tax, already at 2019 highs. That suggests that we're in a new bull market in India. There is some element of speculative froth in the US market. For example, someone just sent me an article that's saying Tesla traded more than all the other components, the next 20 components combined. That is a sign of an excess going on sometime in the US market. 19 stocks, for example, have doubled in the US from the IPO listing price, which is again a sign of a speculative bubble. But are we there at the top? I can't say at this point. It's too early to say whether the US is at the top. But I think the good news for investors in India is that we're in a new bull market, and new bull market suggests that typically the index has much, much higher to go.
Sure. So let's take that point a little forward. what phase of are we in an early bull market? How do you see usually what phase of the cycle are we? Because you've seen several cycles in the Indian market as well.
Yeah, I think, to be honest, we are in the stage one of the bull market. Typically, some of the presentations before I've suggested that bull markets go through three phases: stage one, stage two, stage three, and each stage is characterized by its own set of circumstances. I think looking at that evidence in terms of disbelief in the market, earnings not yet good but looking good, collections, tax collections looking good, no real participation of the public in a leveraged way in the market. All the signs suggest the new number of new highs that we made in the market, the disbelief about the new highs, suggests that we are actually in the early stages of a new bull market. It has taken out the old highs, which were at 37,500 on the Sensex. We are well above that level right now. And typically bull markets in India, let's take the 92 bull market, it went from 1,000 Sensex to 4,500 Sensex. So typically bull markets can double the index and then some. So I think personally that we have a ways to go.
Excellent. Bharat bhai, I will not ask you, the direct question whether index is going or how the market is looking, because I know I will not get an answer. But I would want to know about your investing framework. How have you developed your investing framework over the years? Because a lot of students out there who are already practicing their hand on investing will get to learn from it.
Well, nothing eureka there. And I'm merely an obedient, hopefully disciplined student of investing, because 3.5 to 4 centuries of organized investing record that we have, I think is pointing out there are some very, very meaningful ways in creating successful long-term value. Unfortunately, people treat investing as a gambling device, or a lot of them do, either wittingly or unwittingly. But if you don't treat investing as a gambling device, you treat it as a serious pursuit of wealth creation and all that it calls for, then in my opinion, essentially over long run, when you approach it with due framework, with the principles, with the discipline and the required level of wisdom to approach that matter, there is, in my opinion, nothing safer than equity investments. I mean, on a day-to-day basis, over short periods, the violence or the volatility, either on up or on down, can unduly create exuberance or can deflate people. But when you develop a bit of a detached perspective, you are interested, but you keep a mindset of an observer rather than a very day-to-day kind of a participant in the flow of the river of investing. Then I think it's very, very clear. The rules are very simple. Eventually, you make money not by trying to predict indices. You make money by buying stocks. Therefore, you need to have an understanding of how to identify businesses which are likely to create value. The rules for creating value on a sustainable long-term basis have been fairly obvious and clear. And that evidence of strong and durable earnings growth, more importantly, predictable one, very superior quality of that growth, and longevity over a long enough period. If you are able to get that equation right, along with a quality management which is going to treat your interests on the same side of the table as his, so that they don't shortchange you as a minority investor. If you are able to get that equation right, then there is sound and solid investment mathematics that allows you to convert that knowledge into something called a value. And value is not some precise mathematical number, but it's a philosophy, it's an idea, it's a reasonably close kind of a reflection and a contemplation of what roughly that business is worth. And of course, subject to evolution constantly in the light of new evidence. But once you have a sense of that value, then I think the equation is discipline of buying at a sensible price at some margin of safety, so that you make not just earnings growth as a return, not just quality of the growth, which will aid further to that compounding, but margin of safety as a one-time extra. So all that kind of works into a powerful compounding machine. And more importantly, finally, I would say, markets are what they are. There is nothing we can do about it. We have to take markets as given, their ups, their downs, their volatility, and all that joy and defeat that it offers. The important thing is the externality of the market volatility. We should learn to prevent it to become our internality. If we are able to prevent market violence and spasms and machinations to become our own internal demons, that's where the defeat comes about. Therefore, it's a hard act to do. It's one of the most important psychological factors in dealing with the market, that you observe it like a detached observer. You don't try to make too many judgments about it. I have a reverential attitude towards market. I don't try to believe that at any point of time or over a period of time I have any great ability to make any judgments on the market, because markets are supreme. And even the best mind in investing, or collectively among the topmost minds in investing also, cannot defeat market in terms of ability to quickly reflect on things, ability to bring that into the prices, sometimes rightly, sometimes wrongly, but ferocious quickness and ability to bring about nuances, nobody can match. Only way we can have any hope to run ahead of the markets over a period of time is to be a detached observer, see the market behavior. Markets will do whatever it will do, sometimes away from values on a higher side, sometimes on a lower side. But if you keep your mind cool and calm, then actually that becomes an opportunity. So final act of being an interested participant, but at the same time remaining a detached observer, accepting the wisdom of the market in terms of reflecting future by and large, rather than trying to fight it or trying to act with a supercilious sense of arrogance about it, and remaining with the good things for long enough period of time. I think more than smartness, it is discipline which is more vital, and more than highest raw intellect, I think it is wisdom which is a far greater role in investing. So, which is where I would say, I think the overall picture in my mind is there. So, rules of deciphering value are simple, and thereafter the psychology and ability to do things right takes over.
Ramesh, you had 35 years of experience in the market. Bulk of the students who are watching us today are 24, 25. They have 30, 35 years ahead of them. What are the possibilities which lie ahead? Do you think 15, 16% compounding, which the index has done, is possible? If they indeed get a grip of compounding, what are the possibilities? Where is the country going in the overall scheme of things? What does your experience tell us?
Before Rameshji says, I'll aid. The students here at 25 don't have to look forward to 30 and 35. They should hope to look at 50 and 60 years, because that is where huge amount of additional power of the wealth creation will come.
I think what Bharatbhai was saying is the famous statistic in investing world where Buffett made 95% of his wealth after he was 50 years old and 97% of his wealth after he was 65 years old. Okay, so that's something to remember, that this is a long-term journey that you're on. I think, Ajay, you hit the note that I always try and talk to students when I'm addressing them or in a conference where I'm speaking, is that The only thing worthwhile really to understand in investing is compounding. And the way compounding works is that the longer the runway you have, that is, the more time you have, the better you're going to be for it. So if you ask me one takeaway from this conference, one thing that I'd like to leave your audience with is please understand compounding. Let me give you an example which I've given many times before, but maybe this is a fresh audience, so they look at it from fresh eyes. Let's say you're 25, as you said, the average is 25, and you manage to save 10 lakh rupees of your savings. Now, if you invest that wisely over the next 30 years, and you can have 10 doubles, if your money doubles every 3 years, you will have 10 doubles. The 10 lakh rupees that you started with becomes 100 crore rupees after a period of 30 years. If you compound or double your money every 3 years, which is compounding at a rate effectively of 21, 22%. Now, you say that's almost impossible to do at 21, 22%. Well, yes, but you're starting from a very low base. From 10 lakhs, it's very easy to compound money at 25, you're 30%, till you get to much higher numbers. And you have a long, if you buy stocks, let's say you bought HDFC Bank, if you were lucky enough in my generation by HDFC Bank, you could have held on to it and still done a great amount of time. So getting rich is never easy, but the trick to getting rich is to give yourself a long, long runway in which you can compound money. So time and finding a great business are the two essential traits that young investors really need to look at. Having said that, I think they'll do just fine. I think India will do just fine. We have our own political challenges. Periodically, we go through 5 years of general election. But India itself is blessed because we have a huge population base, 130 crore population base that is gravitating to the middle class. They'll demand lots of services, lots of technology, lots of medicines, housing, education, travel. So you find companies that meet those needs. I'll just point your students out that how in China wealth has been created. In the last year, 2 Chinese have become multi-billionaires building their own brands. Someone built a brand of water and someone built a detergent called Blue Mountain. So there'll be a plethora of opportunities. If you look at the landscape out here, what people have done with cement, what people have done with retailing, there's a tremendous opportunity to service this market. So I think your students in the next 20, 25 years, either as entrepreneurs or as investors, will have their plate full.
Bharat, I want to understand from you. I've always been curious to ask you. Today is a great platform. You are a very critical thinker. You make your hypothesis, sharpening it a lot. In your journey of 3.5 decades, talk to us about some of the companies which you admired, which you saw in front of your eyes take shape, good managements, they build scale, and today they are, industry behemoths. Talk to us about from your experience.
Well, the first company that comes to my mind immediately is Asian Paints. I had an advantage of starting a career with that firm. And as I mentioned, I remain a great admirer of that firm. If you look at paints as a business, it looks a very humdrum kind of an activity. Paints is very simple to make. There is no great technology. It's almost like a household industry, much like soaps you can make at home. You don't do it, but you can make it at home. Even paints is something similar, not very different from that. It's a pretty rudimentary technology kind of a business. But I think what may be simplicity of making the product or without any major technology really involved in that, how beautifully that business has been built. It's a business which doesn't have much amount of fixed assets need. It's not very capital intensive from the fixed asset point of view. But key critical parameter is to manage working capital well, and which is where I think success and failures have been defined. And relentless ability to execute well, earn out small advantages cumulatively, which build up to fantastic things. Business which right from early times, I remember Asian Paints as a relatively young, small Indian company. From 70s, it started hiring management graduates from IIM. I'm a product of IIM Calcutta, and I know that from 70s they had begun hiring from there. I also remember way back in 1973, I was just a young kid. Asian Paints was probably the first company to buy DGC, Data General Corporation, mainframe computer, when computers were completely unheard of things at that particular point of time. So management which reflected modernity, professionalism, at the same time the entrepreneurial fire and capability, that along with a business where you have to work at it all through to build a very strong moat and competitive advantage by relentless, superior and outstanding execution. So much so that Asian Paints today earns a return on capital employed in a business like this at some 60-70%. It's a free cash flow generating machine. Dividend payouts typically tend to be 50-60%. It can be even higher, really speaking, if they want to. Uh, and in a basic product, basic need, how they created aspirational desire over a period of time, and where slowly but steadily consumers have been wooed into falling for the charms of that firm. So for a large firm like that to remain dominant force and raise the market share requires some special capability. I mean, if you look at in decorative segment, their market share runs at close to 60%. I mean, in a large, very, very profitable industry where a lot of competition should come. But here is a company which has raised the game, has improved the margins over a period of time, has improved return on capital employed, has continued to keep juggling along a decent double-digit kind of a compounding machine kind of a growth, and it has raised the market share. So that, I think, it reflects about. So I would say Asian Paints is an example where while business is actually very, very interesting and very value accretive, because if you see over 50 years, not too many paints firms have come. And those who have come mostly have folded by the wayside and have not been able to make the mark. So there is something about the business. But I think the management has done a fantastic job to make a good business into an outstanding one. I would say relatively recently, it is Bajaj Finance, a fantastic management. I would say Bajaj Finance is a case where business quality is what it is. Finance is not some rocket science, and it is not some very secret source driven kind of a business. But this is a business where management quality materially exceeds the business quality. Underlying business quality is sound, but what that good business quality is, in my opinion, hugely owing to that management. The sheer capability, they combine fantastic entrepreneurial capability along with the never want to miss out on opportunity, at the same time great discipline and risk control of not doing silly things. Therefore, a combination of hunger to get more, but at the same time remaining rooted into discipline of doing the right things and not falling for charms of the wrong things is what defines Bajaj Finance. And also, they've been wise and foresighted to invest into technology way before others have done. Finance increasingly is a business where lending and customer union is at the threshold of technology. So technology is a fantastic interface to not only acquire clients, to service them well, to disburse credit, to recover, and to get data analytics, artificial intelligence to do cross-selling. So the way they built that model, relentlessly high growth, yet not losing sight of quality and risk control. That's where the power and the charm of the business is concerned. So that's a business where I've been invested for more than a decade, and I have a huge, huge admiration for the way that firm has been built.
Right, that's correct. Bharat bhai, we all have heard you quizzing the management also several times very nicely. So really enjoy that. Ramesh ji, you've seen. Let me start with technology. Of course, you can always talk about the company that you really like and you admire, not the stocks perspective, but management quality, because you've also seen all kinds of managements in the last 30 plus years, all shapes and sizes, all qualities, good managements, rogue managements, everything. But from your perspective, what are the kind of managements you really admire or you like? Technology is one sector you've seen right in front of your eyes take shape. Talk to us about that.
Sure, Ajay. 2 points. I think I would heartily endorse Bharat Bhai's view. Let me share a small anecdote with you. When Tiger Woods was still 20 years old, Jack Nicklaus, who had already won so many LPG tournaments and PGA tournaments at that time, was asked what he thought about Tiger Woods. And he said, he plays a game that I'm not familiar with. And that was a great compliment that Nicklaus gave to Tiger Woods, saying that even at 20, he plays a game that a professional PGA winner couldn't understand. It was so good. And I find the same thing what Bharat Bhai says, the enthusiasm about Bajaj Finance. I think Rajiv Jain is one of the more extraordinary CEOs in India today. I mean, his brilliance can be seen in his simplicity. So I would urge all your students to try and intern there, get a job there, or at least watch that stock, because I truly find him exceptional in terms of his management guidance. He almost seems to me like a Warren Buffett CEO type, and just look at the stock journey, 5,000 to 2,000 back to 5,000. So this man knows how to pull the company out through various crises. Other than that, Ajay, of course, Bharat Bhai mentioned Asian Paints and Bajaj Finance, and I'm sure if you give him 5 more minutes, he would talk about the technology people. I think we very unfortunately lost truly one of the pioneers in Indian technology, who I believe should get a Bharat Ratna sometime, when Mr. Kohli passed away a few days ago. He, along with a trio of Infosys, Wipro, and TCS, which of course was founded by Mr. Kohli, are extraordinary, and history will record this, that they changed the fortune not only of themselves or the companies or investors, but of the country. They gave us something that we could pride in terms of the software exports now reaching $120 billion. Look at the employment is created. Look at the brand status that Indians have in the world as a technological powerhouse in the software business. And what people have said, that software is as important as oil to us. And I think to those 3 gentlemen, Narayan Murthy, Nandan Nilekani of Infosys, Mr. Premji at Wipro, and of course, Mr. Kohli and his compatriots at TCS, extraordinary gratitude that the country should have. I wish a lot more companies globally were managed as these 3 companies have been.
I just want to add a point to what Ramesh said. I couldn't have agreed more with him. We all owe gratitude to these people, what Ramesh mentioned. I think they not only built reputation for software industry, or they created a lot of wealth and value around, but most importantly, it is one of the most defining moments which has shaped entrepreneurship and the quality and the wealth creation activity in the country. It has given a reputation to the country itself, and it has shaped the future pursuits of the value creation in a legitimate and ethical way, and the stupendous amount yet the value which can be created. So we owe to them way, way beyond merely the performance of those businesses and the value creation. As a nation, we owe a gratitude to them.
Right. Rameshji, last couple of minutes, I would like you to guide our students and our viewers who are in attendance today on some of the things they should try to inculcate in themselves, some of the practices which takes the probability of them turning out to be good investors over the long time higher. Because you have walked the talk for such a long time, you almost know, if not fully, what works and what doesn't.
Ajay, the journey is half the fun. I don't have any hair right now, and I know my audience has a lot of hair. And trust me, I'd switch places with them if I know all I know right now. But I was 30 years younger. So enjoy the journey. The most important part is enjoy the journey. Life is wonderful diversity. We're products of a new generation of India. which is more confident, more outgoing than you were 20 years ago, 30 years ago. So enjoy that journey. I think do whatever you're passionate about or whatever you're good at. I think that's one important lesson. You don't necessarily have to do investing. If you're interested in being a lawyer, be a lawyer. If you're interested in being a teacher, be a teacher. Do what really motivates you to get up in the morning and what you're good at. If you are interested in investing, I would suggest what your earlier speakers have also suggested, is that read. It is almost fundamental in the nature of this profession that you have to be constantly reading. I think my family's often said that I'm a book with two legs because I used to love reading so much. So enjoy reading. And I would sincerely suggest that find a book on compounding and understand compounding. It's the secret to becoming rich. A lot of people tell you how to make money, how to earn a few crores in the market. But very few people understand the science of making a generational wealth. And there is no other formula. The formula is compounding. If you can double your money every 3 years or 4 years or 5 years and do it over a 30, 40-year period, no matter what happens, you'll end up phenomenally rich. I think that is the purpose of life, to be financially free at the end of the journey. So when you're in retirement, you don't necessarily have to work. You work because you want to. Your children can go and have the best education you want. You can retire well. You can take care of your parents' old age. So the foundational aspects of this business to start with are, of course, reading and using your judgment about companies, valuing businesses. The outcome should be financial freedom.
Just to, Ajay, if I'm permitted to add a point there. What Rameshji very ardently advocated, the power of the compounding. It is that very simple truth which needs to be appreciated. Investing can make you seriously wealthy and rich, but that's a byproduct. But more than just that important byproduct, I think the sheer learning, the passion with which you approach that area, and the sheer joy that it gives, it allows you to know so many bright minds, so many good people. It allows you to understand their thought process. It allows you to assimilate all that within you and to make you a better individual, to not just a better investor. All of these, I think, phenomenal joys of investing. Rameshji mentioned about he being a book with two legs on, but that really is true, because the joy of reading is something in many inscrutable and actually tangible ways associated with investing. Because investing is ultimately the business of ideas, and a lot of good ideas and a lot of good thinking, and the sheer joy of reading right stuff. Therefore, if we keep things simple and not complicated, if we remain on the path, and what Rameshji alluded to, I couldn't have agreed more that there is no other way to do it. A lot of time people think that there are 10 ways of reaching the destination. I beg to differ. There are no 10 ways. There are no 5 ways. There are probably not even, there is only one way. And investing is the narrow path. You can't treat it as a highway where with a highway open, with a Ferrari on, without unmindful of risk and dangers. It's a narrow lane, a narrow turning, twisting journey. You have to be careful, you have to be measured. But if you do all of that, the rewards are fantastic in this activity. And therefore, that compounding is really the only way to get that be achieved.
Right. Gentlemen, I'd like to end this discussion before I hand over to Krishna with some book recommendations. Both of you have emphasized quite a lot on it, and it indeed merits that we also get some book recommendations from you. Bharat bhai, what are the 2 books you would recommend our audience to definitely catch hold of?
In books, like movies, it is very, very difficult to say only 2. But
which influenced
Theory of Value by Burr, William Burr, I think is Robert Burr, is a very, very fine book. lattice work is another one that I have enjoyed. Behavioral Investor by Crosby, again, a very fine work in behavioral investing. And plenty of other good stuff. I mean, Phil Fisher's work, very simple, very, very wise and elevating conservative investors sleep well, common stocks, uncommon profits, so many good things to read. I'm confining to the investing. I suppose that is the question.
Right. Rameshji, what about you?
Sure, Ajay. Two books on Buffett that I would recommend are one is An American Capitalist by Roger Lowenstein. It takes you into the head of Warren Buffett. The other book is also on Buffett. It's called Of Permanent Value by Andrew Kilpatrick. Easy breezy style to read. Particularly, I would suggest you read a story of how Buffett invested in Coke. How do you keep the science of investing down to a simple tax? He's shown in that 2-page chapter, investing in Coke. Two websites to make more contemporary, more multidisciplinary. I would suggest that young budding people who want to read a wide variety of subjects, from psychology to money to history, I would suggest two websites called longform.org, and thebrowser.com. Thebrowser.com. These are two sites that I've enjoyed reading on the net a lot.
Right. All right, Bharat Bhai and Rameshji, thank you so much for your time. I really enjoyed. It was an honor for me to be chatting with both of you today. With that, I'll hand it over both to Hitesh's team and Krisha.
Thank you, Ajay. Thank you, Ramesh. Good to see you, as always.
Thank you so much for giving us your valuable time and sharing with us your journey and valuable experience in the market. The key takeaways from this session are the knowledge of investing framework, which will be very valuable for our future managers looking to invest in capital markets. Trick to making great investment is to have a long future outlook and understanding the power of compounding. Importance of technological interface to enhance the business and promote relentless growth strategies can be learned from various companies such as Bajaj Finance, Asian Paints, etc. To conclude, the last but the most important point is to do whatever that makes you happy. Thank you, sir. I would now request Professor Pankaj Trivedi, sir, to propose the vote of thanks.
Good evening to all of you. So there was a wonderful day today, right from morning 10 o'clock till today. And all the speakers were excellent. I'm sure there is a lot of takeaway and there are a lot of learning from everyone. As far as the inauguration session was concerned, that I have already talked about, but panel discussion was also wonderful. To give you some takeaway, to give you some idea about the takeaway, to my mind is Mr. Madhu Kela has narrated very nicely his association with our institute, Somaiya Institute of Management, and how this Investrix was started and all that stuff. But the most important thing which I have noticed from his talk is that apart from money, the capital market will give you a lot of intellectual satisfaction. So that is something which the student should keep in mind. No doubt about it, as every speaker has talked about importance of money, and we also know the significance. But apart from that, it gives you a lot of intellectual satisfaction. So that is one good takeaway. And second aspect which he said is that there is no any theory as such, right? It is you have to learn on your own. It's not that if you follow X theory, you will be able to make good fortune, or Y theory is not successful or something like that. You need to learn on your own and you need to work and operate in the market. So that is what he has said. Mr. Naren has talked about significance and role of central bank. The student of finance are taught in this way that capital market and money market regulators are completely different. They are different. But how the decision of monetary policy decision or the central bank decision can influence the stock market and capital market also, that is what he has covered very nicely. He has also given one advice to the budding investors, and that is asset allocation. So that is very, very critical aspect he has said. Coming to Neelesh sir, he said you need to identify the right business and discipline. The same thing was emphasized by Bharat Bhai Shah also. Identifying the right business and maintaining discipline is something which is very critical to operate and to become success in this market. Mr. Shankar, in a very friendly manner, he has talked with us. He has talked about many things, particularly about his library, about reading the books and all that stuff. And friends, one thing you must have noticed, all the speaker, right from morning till the last part, all the speaker has given emphasis on reading. So it has no substitute, hard work, reading has no substitute. So that is what Mr. Shankar Sharma has covered. Then after that, there was a third session. In the third session, Saurabh Mukherjea and Anupam Gupta, they also have nicely linked spirituality and investment. In a very good way, they have, both of them have linked. They have talked about creativity also in their talk. And the most important thing, which Mr. Saurabh Mukherjea has said that I would like to emphasize here, and the students should also note, that if you want to be a good investor, that is what he said. If you want to be a good investor, then read non-financial book. Because financial knowledge, certainly you can get from the college, from the university. But apart from financial knowledge, you also need to know, as Mr. Ramesh Damani has also said, psychology, you need to understand the economy, all that stuff. So that is one good takeaway. And then finally, in the last session, two veteran speakers, we were fortunate enough to have two veteran speakers, Mr. Ramesh Damani and Bharat Bhai Shah. I thank you personally and on behalf of my institute for taking out the time, sir, and sharing your experience with our students. So Ramesh ji has said that India is a new bull market. So this is something which all of you should keep in mind, that there is a good opportunity. And this is one thing which is a very good point that he has talked about, right? Similarly, Bharat Shah has also talked about discipline in investment, as I already talked to you. So that discipline in investment and identifying good business, needless to say, is very, very critical to have success in this market. And finally, Mr. Ajay Sharma. I should also thank him very from the deep of my heart, because in a wonderful way, he has compared the session, both the session he has compared in a very nice way. And he is able to take out the best from the participants and best from the panelists. That is the most important thing. How you put the question, relating to those aspects where students will have interest. So, sir, thank you very much for your work and your support as usual to our institute. So, thanks to Ajay Sharma. Similarly, my thanks to all the speakers, including the panelists, including the second and the third session, Ramesh ji as well as Bharat Shah. To all the speaker, my personal thanks on the behalf of the institute. I would also like to thank our director, Dr. Monica Khanna. As I said earlier also, she is a source of inspiration for all of us, and she gives us a lot of support to do these kind of activities. So thank you, madam, for that. To my faculty colleague, entire finance department faculty, they are always with me and they always give me support for these kind of activities. So thank you very much to all my faculty colleagues from finance as well as non-finance department, particularly Hitesh. Professor Hitesh Punjabi has done a lot of work and he has put in a lot of effort. Let me tell you that the major credit of this entire event goes to him, because he has worked tirelessly since last couple of months for this particular event. Similarly, Sunil, thank you very much for your support. And I would also like to put on record the support by our communication faculty, Mr. Professor Milind Gawai. Similarly, Fin Street, well, friends, you have done wonderful job as usual. I will never tire to thank you again and again, particularly Krisha, Sahil, very nice comparing, Svikar, Milind to be a leader, Prakhar, etc. All. Suppose I am not able to take the name, it doesn't mean that they have worked less, but Fin Street has done excellent job. Same way, our PR team leader, Mr. Arvind, Utkarsh, Danish, Simran, all they have done very nice job. My students' friends, all other students' friends, alumni, and one more thank I would like to put specially, that is Rahul and Mahesh from the IT department. For the first time, we are doing this virtually. As all of you know, for many of us, this is the first time experience. So to make it effective and to make it successful, both of them have worked tirelessly. Rahul, Mahesh from IT department, thank you very much. And finally, all YouTube viewers or YouTube viewers, for them also my special thank is there. So thank you one and all for this wonderful session. And finally, I would like to end this with just two things: significance of reading. That is the most important takeaway for the students from all the speakers. And I would like to add from my side, simply reading is not enough. You have to think. Along with the reading, you need to think. If you do this, success will be yours. Thank you very much. So with this word, I formally declare the Investrix session as over. Thanks a lot.